banking crisis has been contained, given that there's good access to liquidity in the strongest banks.
Unfortunately, there's more downside in the equity markets than there is upside today.
You need people to stop spending, you need credit to contract, and that's what slows the economy and brings down inflation.
The Fed wants to hike probably once, maybe twice more, but it's really torn because it's got these obvious troubles.
I think the landing could be quite a bit harder than many are discussing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from the nation's capital for our audience worldwide. Good morning, good morning. Down in Washington, D.C. for the World Bank IMF spring meetings with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Equity futures on the S&P 500 just about positive by 0.2%. TK a little bit later this morning. In around about 2 hours and 30 minutes, CPI in America.
CPI is more important than the IMF meetings. I thought yesterday was the strongest Tuesday we've ever had at these IMF spring meetings, and we go right into the theater at 8:30. And what I noticed yesterday is the markets have come to a stop. The volume, I never talk about volume, I don't believe in volume, but the fact is the volume is next to nothing as we await 8:30 this morning.
Would you like to explain why you don't believe in volume?
There's been a lot of research done on this, most of it out of Vanderbilt, of all places. I would have never guessed it, but volume, you can make missed calls with volume, particularly on the short side.
I'm not sure why I started this conversation, Lisa, and asked him why he doesn't believe in volume. Probably not the best way to start this conversation. Lisa, I have to say, the IMF and the commentary from the International Monetary Fund in the last 24 hours, the last couple of days, really, really gloomy relative to what we're hearing from, say, Secretary Yellen.
Growth is going to be really suppressed, and the bank stress is going to cause a real issue for the banking sector, but also for the larger economy. So how do we view Yellen's comments, given the fact that she said, actually, I don't view the banking stress as ongoing. I think it's been resolved, and everything is moving along just fine. Is she discredited as just a political actor, or does she become someone who really is the pole to offset what we're hearing from the IMF, and frankly, to even Fed officials who are using this as an excuse for possibly not hiking as much?
Well, let's talk about the excuse for Fed officials. Goolsbee of the Chicago Fed. Tom, out with a speech yesterday. Actually, really, really great read, I have to say, just reading through that a couple of times yesterday evening. Patience, prudence, the approach from him.
I think this is an economist people don't know. They associate him with the White House. They associate him with political economics, and he's a frontline economist. He's been underestimated since time began. Out of Chicago, but less with a rigorous Chicago tradition. I think more of Gary Becker, the late giant Gary Becker, on his social economics that he dovetails into rigorous mathematics. It was quite a speech.
CPI coming up a little bit later this morning. We'll count you down to that. Going into it, here's a snapshot of the price action for you. Starting with the S&P 500. Equity futures here positive by 0.2%. It yields a little bit higher on a 10-year by a couple of basis points. 3.45 on a 10-year yield. And the euro stronger again, just about, Lisa, here. Euro dollar 109.28. We're positive there by a little more than 0.1%.
It is CPI Wednesday, in case you didn't know, in case you hadn't heard John mention it a couple times today, 8:30 a.m. Eastern. What I'm looking at here is core. I'm not looking at the headline year over year. It is noisy. It'll be made noisier still based on what we're expecting from oil prices, which went down substantially but have since rebounded quite a bit. I'm curious whether we get a big market response to an upside surprise in core CPI. There was a report out of Goldman Sachs saying that you could see a 2% decline in the S&P if you get some sort of, 6% surprise upward. I'm not sure what you could potentially see with that. 10 a.m., the Bank of Canada. I always watch the Bank of Canada rate decisions. I know that other people say, it's not a big deal. But they've been a front rider here, and they basically may hold at 4.5% for a second straight decision, even though economic data has surprised to the upside. How do we see this read through in the yield space? The two-year yield has seemed to have peaked out, but what about longer-term yields? Do we see them pop upward with the fear of inflation getting more concerning? And at 2 p.m., we get the FOMC meeting minutes. Normally, they're pretty dry. This time, we get a sense of how important bank stress was in their discussions, even as they raised rates. We also hear from Tom Barkman of the Richmond Fed and Mary Daly of San Francisco. John.
And whether anyone wanted a pause.
Right, exactly. Basically, we find out underneath the mechanics of this decision and how much dissent there was as Goolsbee really pushed out there this feeling. This is concerning. This could potentially create real stress.
Do I get an IMF freebie pass so I don't have to read the minutes today because I'm overwhelmed with my work at the spring meetings of the IMF?
Well, there's the IMF and the IIF, and we do hear from Andrew Bailey of the Bank of England. He is going to be speaking today, and there's a whole host of other discussions. We will be parsing through them throughout the day.
Governor Bailey's listening to?
Who's that?
Ibrahim Rabari.
Of course he is. That's who's with us now. Ibrahim Rabari, the global head of FX analysis over at Citi. Ibrahim, good morning to you, and welcome to Washington.
Well, it's great to be with you in the studio, in the flesh.
Let's talk about CPI, 8:30 Eastern Time. What are you looking for a little bit later?
So in general, we think that the risks are to the upside once again for this CPI print. So our colleagues in economics are seeing core CPI at 0.5 core, but with upside risks, where a lot of the upside risks, as you said, are maybe in some of the smaller categories. Used cars probably pop up quite sharply. But what policymakers have been watching closely is what's most closely related to shelter. So core services, most closely related to wages, I should have said. Core services ex shelter. But what I think is important in this reading is how the Fed will interpret it. Because the way we look at the Fed at the moment is they're probably going to take any excuse to be more patient or more prudent, as Goolsbee said. So we think a modest upside surprise could probably be shrugged off, both by markets and by policymakers.
President Goolsbee also talked about the data elsewhere, not just the traditional indicators, CPI, payrolls, GDP. We need to talk about bank lending data, what's happening in the banking system. Is that a reason for them to pause, to have that patience, to wait?
So I think there are many reasons at this point to pause. And I think going back, it's simply reflecting that we've had the fastest tightening cycle possibly in history, that many of the effects are yet to seep in. What we like to highlight is if you look at the mortgage market in the US, maybe 10-20% of the rise in Fed policy rates has now seeped into actual mortgage rates that households are paying. So even away from the banking stresses, we think now would be a very good time to pause and reassess. There are big nonlinear risks out there. But of course, the banking situation is creating a new layer to these uncertainties. So the Fed certainly will be looking at that with great attention. The data we got from the Federal Reserve Bank of Dallas recently pointed to some signs of I think, at least unease about lending. But we think even when it comes to the lending data, we probably will only know over the next 6 months or so how these conditions will evolve. So lots of reasons to be prudent and patient.
But taking a step back, just to sort of give a sense of how the Fed is weighting these two issues, what's more important, today's CPI print or what we get from J.P. Morgan on Friday?
Well, it's a very good question. And I think if you ask the Fed, they have to say it's about inflation. And they're not yet at a point where they're comfortable with the trajectory, let alone the level of inflation. But I do think that when you're an investor, you have to take a step back from the spot data. You have to now look forward. You have to look at forecasts again, when we were discarding forecasts for a long time. And, bank earnings, and not just the big bank earnings, of course, a lot of the small banks are much more in focus, are probably going to be more informative than CPI data, which in many respects is backward looking at this point.
Ibrahim, I look at the debate right now. John and I were thunderstruck yesterday at some of the interviews, the intensity of belief in a slowdown a la what the IMF is programming for 5 years. You have a weak dollar case. Do you need a 5-year plan to get to a weak dollar as you and Kristalina Georgieva see it, or does it happen sooner?
No, we actually think of dollar weakness as a near-term window. It's that...
Well, Friday or, September?
It's been going on since the beginning of the year, and for now we think of it for maybe the majority of the rest of the year, or maybe at least into the end of Q3. We have these debt ceiling issues that we think won't be helpful to the dollar as well. But we think that there is a final hurrah waiting when the rest of the world catches up with that U.S. slowdown. A global recession in 2024 should still be the base case. I actually think that will come back to be somewhat dollar supportive. So for now, it's a dollar-centric weakness window for the next 1 or 2 quarters from now.
What's fascinating to me, summing up 2 days here, is the idea that Goolsbee, with that important speech of Chicago, and Michael Daugherty yesterday channeling an ancient Chicago school, which really looks for a slowdown of real economy and slowdown of inflation together. That seems to go against Hollenhorst and Clark, What does the dollar do? Dardis says the Fed has gone too far. He says they've lost the plot. If they have to confront lower nominal GDP, that's got to be yen 110, yen 95, euro 130. Can we think of those magnitudes if we get that level of Fed failure?
We think eventually, yes. So when it comes to when we get to and through the recession and maybe to the multi-year the multi-year part of the dollar down cycle, then we think the euro dollar above 120, dollar yen below 110 are certainly very close.
We got to make news here on a Wednesday morning. Can we get yen below 100?
I think we will still see it in the course of the next few years, but we have plenty of gyrations between now and then. And you mentioned nominal GDP growth. We think the Fed worries about inflation. When nominal GDP growth is weak, they'll have a whole host of other problems to contend with. So you have to be careful what you're wishing for at this point.
Ibrahim, this was great, as always. Ibrahim Rakbari there of Citi. Thank you, sir. Talking up the potential for a global recession in 2024, I think that was interesting. 2024, and then you shift to the other side of the dollar smile. And that's where the dollar support starts to come in, maybe, going into next year.
But until then, the bank stress and potential dovish, hawkish, kind of surprise that you could get from the Fed could provide, as Ibrahim says, a buying opportunity before what we get in 2024.
A lot of people have booked European vacations, Tom, in the United States for this summer. I'm not sure they're hopeful about 120 euro dollar. 120?
Yeah,
130. You were talking 130.
We're egging them on. I mean, it's way too early in the morning for Ibrahim, but the bottom line is the scope and scale of 130 euro. John, you've lived it. That changes things in Europe, and frankly, I don't know. Do you extrapolate that out to a 128 sterling? I mean, that's.
I remember a time when
these are big moves.
130 was poison for the ECB because they wanted the euro weaker, and how things have changed. The story's changed in a big way.
Well, and again, I think we didn't discuss it here. We'll have to have Ibrahim back here, but one of the backstories that's IMF is the Bank of Japan's new leader in what's going to happen with yield curve control. That's a whole separate issue.
When it comes to the fact that the euro has been as weak as it has, have you seen the crowds at the different tourist centers in Europe? It's been unbelievable, these sort of record hordes of Americans. I wonder if people like it or if they don't. I bet it's a sort of a bittersweet.
You mean the locals?
The locals, yeah.
The locals? No, I think the locals in Europe love the American tourists. If you work in hospitality.
Of course.
Great tippers.
Great tippers, because Europeans don't tip, do they?
Well, the Brits have a reputation for not tipping so much, but that's because we pay people well, so that we don't have to.
That was very defensive. Glad to know.
It's a point of tension at the moment. We can build on that another time. Fantastic lineup of guests down here in Washington, D.C. Amy Wu Silverman of RBC Capital Markets is going to be joining us in the next hour. Equity futures on the S&P 500, just about positive.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, we have the Biden administration is proposing a tough crackdown for auto pollution. Right now, tailpipe emission limits are so strict that they will compel automakers to ensure 2 out of every 3 cars sold in 2032 are electric models. But still, there's questions whether car companies can fulfill the fleet-wide limits on carbon dioxide and smog-forming pollution. President Biden is in Belfast, Northern Ireland, where he'll mark the 25th anniversary of the Good Friday Agreement. Now, that deal ended decades of violence between Catholics and Protestants. The president's also meeting today with UK Prime Minister Rishi Sunak. Officials at the Fed are signaling there's a divide over raising interest rates again. New York Fed President John Williams says there's still more work to do to bring down inflation. Meanwhile, Chicago Fed President Austin Goolsbee became the first official to suggest that policymakers may need to hold off on further hikes for now. We get the latest numbers on consumer prices at 8:30 New York time. Donald Trump wants a 4-week delay in the start of a civil trial over his alleged rape of John Carroll. Now, his lawyer says a cooling-off period is necessary following his indictment of the case of hush money payments. The trial in the Carroll case is due to start April 25th. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
given how much uncertainty abounds when these financial headwinds are going, I guess I think we need to be cautious. We should gather further data, and we should be extra careful about raising rates too aggressively until we see how much work the headwinds are doing for us in getting inflation down.
That was a brilliant speech by Austin Goolsbee, the Chicago Fed president, delivered yesterday, pleading for patience, prudence, and we can talk about it all a little bit later. I'm happy to say that Lisa's back in the building. Good to have her back. Lisa Abramowicz, Tom Keene, Jonathan Ferro. This is Bloomberg Surveillance, and here's a taste, a flavour of the price action going into the opening bell in a few hours' time. Before we get to that opening bell, US CPI just around the corner, about 2 hours and 12 minutes away. Equity futures going into that positive 0.2% on the S&P 500. Tom, yields just a little bit higher here on a 10-year, 345, yields higher by 2 basis points. Euro showing a bit of strength, dollar some weakness. The euro against the dollar, euro-dollar 109.30. We're positive there about 0.2%.
One trend here, John, not mentioned, is a Bloomberg Financial Conditions Index with an absolute total complete vengeance has moved from restrictive to a more accommodative stance. It's not above the zero mark. It's a standard deviation measurement, but we've gone from a negative 1.2x up sharply in 17 days to a negative 0.14. I think it's underplayed. And this goes to the dynamics of the moment based on the data. It'll be interesting as one example how that plays off the inflation statistic at 8:30.
I think for much of the last 12 months, we've gauged financial conditions based on what equities are doing, what the dollar's doing, where credit spreads are. Increasingly over the last month, Lisa, we've seen a shift. The focus now is going to be on lending standards, the Senior Loan Opinion Officer Survey that I believe we get in early May. That's going to be a big focal point for a lot of people to gauge where financial conditions are going.
The problem is it's completely ambiguous and there's no actual metric for it. So it's a guessing game. And how do you have a guessing game at a time where the rest of the economy is also a guessing game, on top of a guessing game, on top of an assumption of where we're heading, which everyone agrees to disagree upon, where IMF is basically saying we're going back to where we came from. And many other people, I would argue most other people, think we're going to enter a higher inflationary regime post-pandemic.
When they say data dependence, it always sounds objective, doesn't it? It sounds really objective. We're about the data, data dependence. We're dependent on the data. It's highly subjective. You get to choose which data matters more to you, what weight you put on, say, CPI, on GDP, on payrolls, and how much weight you put on the Senior Loan Opinion Officer Survey that we're going to get a little bit later.
It's data dependency whack-a-mole. I mean, honestly, at what point do you end up just basically looking around for what confirms the story that you want to tell? Because how do you put, for example, what we get from JP Morgan on Friday into the data bucket? Because that's where it's going with respect to how much they're going to be looking to what we're seeing going forward with lending standards.
Or I should say Senior Loan Officer Opinion Survey.
May 8th.
Thank you. Thank you for that. May 8th. And I believe Chairman Powell will actually have some understanding of what that looks like when he meets with his committee, Tom, on May 2nd, May 3rd.
Yeah, I'll go with the banking data, but frankly, this morning's data point is, I'm going to suggest, the most important data point to May 3rd. And I mean, it could be right on plan and boring, a snooze, and, snooze fest and off we go, but we just don't know.
Priya Misra of TD thinks that, for the market at least, bank earnings and this kind of lending data more important than CPI.
Yeah.
More important than CPI.
Yeah, and again, deposit flows. And again, I looked at the BTMM screen today, the classic money market screen of the Bloomberg. And John, I look at 3-month LIBOR, and that's all you got to look at. You don't have to look at anything else. Money market funds reign supreme.
Well, it speaks to the deposit flight.
Yeah, and continued. And even if it's a slower level than 2 banks going under in California on bad marketing plans, the answer is you're going to have a continued flow. Speaking of flows and looking at flows of goods and of trade led by sanctions is Daniel Tannenbaum. He's global anti-financial crime practice leader at Oliver Wyman, I should say, senior fellow at the Atlantic Council. And far more importantly, Dan Tannenbaum is down here. As a kid, he played Risk, like he'd be 3-on-2 Central America, and we played through the dull summer months, the game of Risk. You're doing it in reality here with scenario analysis. What scenarios are you looking at in Washington?
Realistically, there's a few things going on in the world. I mean, if you would have told me 2 years ago that Russia would be sending its aircraft to Iran for routine maintenance, I would have said you were crazy. You're now seeing China broker peace deals between Iran and Saudi. I mean, the whole geopolitical landscape continues to shift. But for a lot of my clients, especially off the back of the last year with Russia, really beginning to look at some of the China-U.S., China-Western tensions to see, what do we need to be prepared for in the event that things get worse? Now, China is a much more rational actor than Russia by a country mile, But I think folks got burned on Russia, lost significantly. Now you have assets being nationalized or threatened to being nationalized. No one wants to be caught flat-footed, so people are really trying to look at the what-if scenario right now to see how can we prepare accordingly.
Earlier this week, Peter Cheer was on the show with Tom and John, and he said that this is a more perilous time geopolitically than we've seen in a very long time. His crew of military leaders, former military leaders, assessing this. Given that, how are some of these companies preparing for that? The steps that they're taking amid all the other risks with inflation and growth concerns?
I think they're really looking at the unintended consequences now, kind of if this, then that. So let's say you sanction, there's heavier sanctions on a commodities sector, for instance. Technology companies that purchase certain precious metals to use downstream in their supply chain, there's a cost to that. There's a cost to consumer. When you look at country-related sanctions where there's significance, you're really trying to look at how to safeguard your IP, how to safeguard your human capital. There are no good answers to this. There's really just a whole bunch of scenarios and playbooks to really look to try and iron out what could happen, what can we do. But there's no good answers. That's really the challenge.
Are your clients worried about stranded assets in Taiwan or China or both?
My clients are worried about stranded assets in any country where there's broader geopolitical risk, some having had stranded assets in Russia, some that are on the verge of being nationalized. So I think at this point, they're really looking everywhere, but it's not just those countries. If you look at the other countries that are known to be supporting Russia, for instance, the UAE has a ton of pressure on it for all of the influx of Russian capital. That could also backfire on businesses operating in that region if the U.S. and its allies tend to focus more harsher enforcement and sanctions on those that are harboring Russian assets that they may not want there.
Well, key phrase there, the U.S. and its allies. Where are the allies of the United States on some of these issues now? And are you convinced that if they tried to impose sanctions on a place like China in the way they have done with Russia, that those allies would be on board?
So China isn't Russia, and I think China has taken an extremely measured response to all of the issues, even thinking back to the Trump years and the bluff and bluster, as Tom would say, of some of the Trump rhetoric against China. China's responded very measured, and I think that business reacts to that and recognizes that you're dealing with a much more rational actor that sees the downside risk to their economy. And companies are aware of that, but they also want to take certain precautions to make sure they're not caught flat-footed.
Lisa, by allies, of course, I'm alluding to one person.
One person.
In particular.
It was
over
quite
the last
clear.
Week.
Emmanuel Macron. You're basically saying, is he going to come out and say, well, you know, we're a friend to China, so come do business with us? And I actually wonder if any businesses are actually reducing some of their assets in those nations, or if they're just making lip service.
There's so many conversations that we've had so far this week down in Washington, Dan, keep coming back to the comments from Emmanuel Macron.
Who? Sorry?
What did you make of that?
Look, I mean, I don't think those comments were on behalf of the bloc. I think those comments were definitely on behalf of France. And if that is the case, in reality, I think that's a far better outcome for geopolitics. If that was representative of the bloc's view, then that might be a slight problem for what's trying to happen on a broader Western campaign of alignment.
Just a bit. Dan Tannenbaum of Oliver Wyman. Dan, thank you. Those conversations keep coming around, Tom. I've said it a few times. Not for me to imply that he was doing this for self-interested reasons, but certainly we're not talking about the burning streets of Paris right now, are we? We're talking about...
That's next week.
...other things.
I think Tannenbaum, his scenario analysis for Elon Musk in Shanghai, now that's a document I'd like to see.
Oh, yeah. Big time.
That would be,
New facility in Shanghai. Lots of investment there in a big way.
Tannenbaum does. He does scenario analysis.
Should we do some of that scenario analysis next time?
Yeah.
OK. Can we do Tesla specifically with you, Dan?
No.
No, didn't think so. Equity futures positive on the S&P from Washington. This is Bloomberg. Live from Washington, D.C., this is Bloomberg Surveillance. Here's a taste of the price action 2 hours out from the CPI report in the United States of America. Futures positive by 0.2%. Yesterday, a total snooze on the S&P 500.
Snooze fest.
Totally unchanged. Bit of weakness in the Nasdaq, bit softer. Yesterday, this morning, positive 0.1%. Elsewhere in the bond market, 2s, 10s, 30s shaping up as follows. Your 2-year going into this print Yields higher by 3 basis points, reclaiming a 4 handle on a 2-year, 4.0539% on a 2-year yield. Just to round things out with foreign exchange, just a sneak peek of euro-dollar for you. The euro stronger this morning against a weaker US dollar, 109.27, positive there by a little more than 0.1%. That's a price action. For a summary of the conversations on this programme, I want to point out Lisa's latest work. Subscribe to the Bloomberg Surveillance newsletter. There we go. Bloomberg.com/surveillance.
What was that?
Subscribe at Bloomberg.com/surveillance.
What's the goal here, Lisa?
Basically, to understand the main themes of the day that we talk about. And also, we have so many amazing conversations with people to understand and distill the main debates that kind of come out, the sort of threads that sort of emerge every day. I personally think it would be helpful.
Can we rename it the Daily Gloom, the Daily Anxiety?
Yeah, we were going over
the Toxic Brew.
We were thinking about a branding.
I actually know that because I got a couple of votes for Toxic Brew.
Toxic Brew is pretty cool.
The morning Toxic Brew.
Toxic Brew is pretty cool.
Sorry. I think it pops.
Toxic Brew works.
Yeah, well, only if when you open it, you get burp, burp, burp every time you open it.
We should put that in too. Just some sound effects. Please, subscribe. We'll talk about it through the show. Subscribe for Bramo. Okay, 2 hours away. Is that enough?
That's
enough.
That's
okay.
enough.
CPI coming up a little bit later this morning.
Time.
Big banks out with their estimates already. Bank of America, Wells Fargo, Goldman, Morgan Stanley, all forecasting 0.4%. An increase of that in core inflation month over month. Meanwhile, JP Morgan and Citi expecting a move, Tom, of 0.5%. So JP Morgan Citi looking for 0.5.
Right.
Core month over month is this big focus for Wall Street, and it has been over the last several months.
Big change year over year is sort of, durable goods. You look at a 3-month moving average. Everybody has a convention, and here it's year over year. And what, John, 6 months ago, the adults totus moved to month over month. I mean, that's
without a doubt. Just to picture the trend, just to get an idea of the trend.
So let's do that right now. Blarina Urichu is U.S. economist at T. Rowe Price. This is really important. Just did a great panel with her with Quinnipiac that was just wonderful. And I want to go to where we were there, which is really dive into the inflation data. So the zeitgeist is goods and services. The focus is on services. How does real estate distort the report at 8:30 this morning within the services vector of inflation?
That's a great question. We're talking about a third of the CPI basket, which comes from the rent and OER components. That's reflecting real estate, the tightness in the housing market in the U.S. We don't have enough rental units, so rent prices increased significantly post-pandemic. And then the quirk of the CPI is that the way the tightness in the housing market feeds into that index is very, very lagged. So we're dealing with quarters and quarters of high rent components in the CPI basket when the housing market itself is starting to cool.
I saw, I believe, in the Telegraph today a discussion of how Britain is now rolling over within a floating rate set of statistics to a new reality on inflation, a reset in mortgages. And it's like, we don't have that. If it's lagging, how lagging is lagging? How far out do you look to get the reset of the inflation we're living now?
So we have two different things going on here. First of all, the lags with the rent and OER components are about 6 to 12 months. Mm-hmm. So I'm looking at the middle of the year at the earliest where we might see some signs of easing in those components of CPI. And then in the UK, we have a floating mortgage market. Here, mortgages are fixed for 30 years. So the way they feed into the price components are also very different.
Are there reasons for the Fed to have a bias to look for an excuse to not hike more? Is there a reason in the data that perhaps isn't coming out in the headline figures that we're going to get today or even in the core, but underneath in the small components feeding it?
So when you look at the data right now, what we have to realize is that they are backward looking. All the information we're getting now are data before SVB and before the bank failures. Now, going ahead, we're expecting some tightening in credit conditions, which will affect the economy and inflation with a lag. What we're seeing now, it's very strong, and it speaks to a different world than what we're living right now. And so for the Fed, I think this will be interesting because they're making a policy decision based on something that is not forward-looking.
Is bank stress disinflationary? There was actually a really interesting report talking about how it's stagflationary, because if you reduce credit, then companies are forced to produce less and basically raise the prices. So isn't this essentially a recipe for stagflation, whatever way you cut it?
You are basically raising the cost of capital, the cost of doing business. There are theoretical models that make the same point, Lisa, that this can be inflationary. Now, and when you look at the history of data, the way credit crunches work on the economy, they have long lags. So this is not going to be short-term disinflationary for the Fed. I don't think so.
Does the Fed have the luxury of waiting? Does it have time on its side?
I don't think they do. I think they've made it very clear also that they need to at least get to what they promised us on the summary of economic projections. And they also need to stay there for some time. Time and again last year, Powell made the analogy that he does not want to be the Burns of this generation. He does not want to cut interest rates too soon.
He doesn't want to be Burns. We've raised the question.
I don't see him being George Burns in the press conference.
Whether he risks being Trichet and hiking into a crisis. Does he run that risk as well?
I think he does, and that's a risk that they are prepared to take based on their reaction function and their communication, that they would rather over-tighten than under-tighten and have to do more down the line.
Well, this is a key theme here in the last 48 hours. Right now, are they over-tightening? And if they go 25 on May 3rd, what level of over-tightening is that?
So we're all a little bit in the dark because we don't know what the equilibrium interest rate is in real time. But based on how the economy overall is behaving, and by that I mean the real economy, the labor market, it doesn't feel like the Fed has over-tightened. Based on what's happening in the financial sector and banking system, maybe rates are a bit too tight there. So we're going back to that discussion we had before with R star and R star star. Maybe the financial stability interest rate, equilibrium interest rate, might be lower than the real economy equilibrium interest rate. And that's what we're finding out this quarter.
That's a raging debate right now. When you get 8 economists in a room, John, you're going to get 9, 10 responses to R star, R star.
Particularly now.
For those of you at home, there's R star, star, star. That happens after 5 p.m.
Sounds like my family.
When I look at R star, 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 it's a bunch of theoretical mumbo jumbo. Our listeners, our viewers are living tangible inflation. When do they, besides a 12-month look back where they get solved, when do they feel better?
So that means when is inflation down in a meaningful way, but the labor market has not deteriorated dramatically. This is the fine line that the Fed is trying to walk, right? And there is no guarantee that this is going to happen. When you look at their summary of economic projections, they're telling us they expect the unemployment rate to increase by 1 percentage point. If inflation slows but the unemployment rate increases, that doesn't feel great. And then they're at the same time saying that this is not necessarily a recessionary outcome. But you look at the sum rule, which tells you historically, once the unemployment rate in the U.S. increases by 0.5 percentage point, you're in a recession.
We've talked a lot about how cash is flooding into money market funds. And if you take a look at 3-month yields in the U.S., they are the highest relative to 10-year yields going back to the early 1980s. Could this alone end up actually causing some sort of recession by just draining the entire economy of cash?
So banks face an interesting situation here where reserves are coming down fast. And actually, when you look at the level of deposits during the pandemic, it was growing at a above trend pace. And so we're going to see ongoing normalization in reserves and lower deposits. And the flip side of that is that money market funds are getting some of those inflows. And what do banks do if they have fewer deposits? They're going to lend less. And that's not going to be a positive for the economy. Now, the lags through which they feed to the economy, I think they can be quite long. So just before we don't see credit really falling off a cliff in the next 3 months, I don't think we should feel comfortable that the worst is past us.
Blorina, thank you. Blorina Urici there of T. Rowe Price on the latest in this U.S. economy. The labour market, 3.5% is the unemployment rate right now. I think we lose sight of that sometimes. 3.5% is the unemployment rate. The Federal Reserve's got a forecast for year-end this year. So it's April, 8 months away. They think unemployment's 100 basis points higher. 1 full percentage point higher, 4.5%. I think this is the kind of pain that Blorina's talking about that we haven't yet experience, and when we do, I just wonder how much things will change.
Well, I see with the jobs report, when Mike McKee rips apart the numbers, and the cross-minority unemployment rates are something I or Elizabeth Warren never imagined. And Senator Warren, I think at 3.5% has a great point. Why aren't we celebrating this? and solving inflation other ways.
Well, the problem is that on one hand, if you have people who are fully employed, they're going to keep spending. And if they keep spending, you end up with a more persistent inflation. That's the theory. On the flip side, if you start getting layoffs, that also has a cycle of its own. And once they start, they feed on each other. And this is the fear. This is sort of the tipping point. Are we ending up in a situation where either we're overly employed and can't get inflation down, or do we start a cycle of unemployment that is very hard to stop? And that, I think, is really the big fear.
The Fed's got it going from 3.5 to 4.5, then 4.6, and just kind of flattening out over a couple of years. It's all very calm and smooth.
Exactly.
From there.
It's a managed statement forward.
Is it ever that calm and smooth?
No.
It doesn't work that way.
Totally. You're going to get me going here. I haven't had my morning tang. The answer is no. You're 100% right. It's not predictable, and these are well-meaning officers. I mean, no ill will. They're managing a controlled glide path because that's public policy in a political milieu.
Well, talking about a political milieu, how do these projections really face off with a political cycle when you have the likes of Ron DeSantis already coming out and really eviscerating the Fed currently and saying that this is all politicized and that they were too late and that they're moving too fast and they're going to be the piñata no matter what? So how do these projections change to really get their will
I don't think they'll
through?
change based on politics. I think they're going to do their best effort, as Blarina mentioned, of lags, to try to guesstimate in always a challenging environment without politics. I just don't think they're going to sit there and go, DeSantis is behind by 20 points. Change in the minutes. Take out several and put in few.
Yeah.
Is he going to announce anytime soon?
What, Ron DeSantis?
Yeah.
Hasn't he announced already? I mean, basically, it's like de facto.
It's not official yet. Isn't this a book tour? I thought this was a book tour.
Oh, right.
It's a book tour.
Oh, whatever. Does anyone buy that?
It's
anyone?
a book tour. I'd buy it. It's a book tour.
You're buying the book?
Yeah, I buy everything politicians say. It's a book tour.
We're just going to leave that there.
Coming up next,
silence.
Tim Adams of the Institute of International Finance. That conversation from Washington. Live from the nation's capital for the IMF World Bank spring meetings. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Last month, policymakers shrugged off bank failures to deliver a 0.25 percentage point rate hike. Today at 2 p.m. in Washington, we find out the thought process behind their decision when the Federal Reserve releases minutes from that meeting. The March rate hike brought their benchmark rate to a range of 4.75 to 5%. China indicated it will maintain pressure on Taiwan following its large-scale military drills. Now, the maneuver began after Taiwan's President Tsai Ing-wen met last week with U.S. House Speaker Kevin McCarthy in California. A Chinese spokesman said, quote, "We will not leave any room for any form of Taiwan separatist activities." Senator Tim Scott of South Carolina is one step closer toward challenging Donald Trump for the Republican presidential nomination. Bloomberg's learned that Scott is launching an exploratory committee that would allow him to start raising money for a campaign. He's visiting several early voting states this week. Walmart is cutting the number of stores in Chicago in half from 8 to 4. The nation's largest retailer says it hasn't made any money in its 17 years in the city. Walmart faces tough competition in Chicago from Target, Albertsons, and Aldi. It says that crime and theft were not main drivers of the decision. Bloomberg's learned that Emerson Electric is in advanced talks to acquire National Instruments. Emerson has offered $60 a share for the maker of measurement systems. National Instruments closed Tuesday at a little more than $52 a share, giving it a market cap of $6.9 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We have to be vigilant because some of these pockets of vulnerabilities could spread, and then they could spread to the whole financial system. But what we are seeing right now is the risk that banks are going to look at the outlook and are going to be a little bit more prudent in extending loans going forward, and that could weigh down further on economic growth, both in the U.S. and in the rest of the world.
Super gloomy stuff from Pierre-Olivier Gourinchas there, the IMF chief economist. We'll pick up on some of that gloom in just a moment. Live from Washington, equity futures going into the CPI report a little bit later this morning at 8:30 Eastern Time, shaping up as follows. Positive by a little more than 0.1% on the S&P. Yields a bit higher as well by 2 or 3 basis points this morning, Tom. 345.43 on a US 10-year.
And then we'll look at 8:30 to see how that changes. I'll be looking at the 2-year. I mean, inside, you got to look inside as well, 3-month and 1-year paper, John. But to me, the 2-year is the thing to look at.
Back above 4% this morning, Tom. 4.06% or so.
Yeah, and that's a substantial move over the, in the wait and see of the last 3 or 4 days. Right now, we're going to wait and see on a banking crisis. We do this with Timothy Adams, president and chief executive officer of the very important IIF, the Institute of International Finance. This is a gathering of, I'm going to say, the large bankers, and he's going to get upset with me. I mean, that's what he's going to say. The stereotype is it's 4 bankers and you. Is it you, Moynihan, Diamond, and the rest sitting around one table? Who is the IIF?
400 institutions, 65 countries.
I nailed that. Thank you. I nailed that. This is a unique occurrence, folks, and we're going to audible here on this banking crisis and your fury over it. I'm going to go back to 1833 and a guy from Tennessee. Yeah. You grew up in the aura of Andrew Jackson, and he said our biggest fear is bank consolidation. If we went from 4,000 smaller banks, they're not part of IIF, to 3,000 smaller banks, would anything change in your Kentucky?
No, not at all. And if you look where we were in 1930, we had 30,000 banks across the United States, and now we have 4,200 FDIC-insured institutions. The trajectory is pretty clear, not only in the United States, but globally. We're going towards greater consolidation. Technology, it's a scale business. And the cost of technology, whether it's for AML or for providing a customer experience on the front end, is incredibly expensive.
My concern with this, it's so important, is we had a marketing scheme in Silicon Valley wrapped around the gauze of a bank. We all had enjoyment watching this SVB blow up. The concern that we have to have is the new banking environment we have. What does IIF say other than read Jamie Dimon's annual letter?
Well, Jamie Dimon's annual letter is pretty darn good, so I'd urge everyone to read it. Look, we have consolidation. It's going to be a different system going forward. Technology has dramatically changed the way in which financial intermediation happens. And artificial intelligence, the ChatGPT revolution, is going to only accelerate that process over the coming months and years, and it's happening at a breakneck pace.
You don't think this is a banking crisis?
I don't. I think it's a market turbulence. As we have transitioned from a period of low negative real interest rates, huge fiscal support, look at the deficits we've run, and you read our annual debt report, to a period that's more normal. But going from one transition to another, we were going to see things pop. I didn't think it was going to be Silicon Valley Bank, but I do think we'll see other stresses in the system. That's not a crisis.
What kind of stresses are you expecting to see?
Well, there's a lot of concern about commercial real estate, something we've been watching. I don't think it's a crisis, but I think it deserves our attention over the coming 24 to 36 months.
Is there something about what's happened with some of the smaller regional banks that's going to lead to issues in CRE?
Well, certainly there's a feedback loop, so that's why I think it's worth watching. And there are concerns. But if you look at credit card data, is still pretty strong. C&I is still pretty strong. Obviously, commercial is down. But the system is pretty normal. Think about it. 99% of our banks in the United States or globally over the past 4 weeks opened their doors and had normal business. This is a small slice of very unique idiosyncratic institutions.
No one enjoyed watching it and its demise. No one enjoyed the fallout of companies that are struggling to wonder where they're going to get the money to make paycheck. There also was a larger question around what does systemic mean in a new era when there are specific banks that have a dominant position in specific businesses. How has the idea of systemic been redefined?
Yeah, I think it's concentration risk. SVB was the dominant player, not only in Silicon Valley, but in the Research Triangle in North Carolina, for example, 6,000 institutions it supported. So it's concentration risk. So we need to think about other institutions that are dominant players in a particular industry or region and ask ourselves, what kind of risk does that pose if they become stressed?
How much of that equation is shifting to a geopolitical question of which banks have more dominant positions in specific countries where there are increasing tensions between, say, the U.S. and China or the U.S. and certain Middle Eastern nations?
It's a great question, as I just said, as we were coming on air. It's the geopolitical issues I still worry about. I was in Japan last week. The dominant conversation was U.S.-China relations. U.S.-Russian relations, or China-Russia relations. President Macron had just visited, landing in Beijing. Those are the issues that keep me up at night.
How concerned are the executives you meet with? How much do they feel like there is a storm bearing down, as Jamie Dimon was talking about, or reflect the gloom that you hear from the IMF projections?
You know, coming into the last few weeks, we've really tried to look through the cycle and be prepared for 2024, which is do we have the technology, do we have the talent for recovery and growth? But it's the geopolitical concerns, the fragmentation, which the IMF talked about in their annual report, the issue of U.S.-China relations, which seems to get worse by the day. Those are the things they're most worried about.
Is there anything that your partners, financial institutions, are actually doing that would suggest there's anything to worry about with regards to China? Don't they all just want to be there?
Well, China's been an allure for, 150 years.
Has that changed?
But I think there is questions about de-risking, as we are seeing with respect to all supply chains, not just the financial sector, but the real economy as well. I think we have to worry about what are the risks of operating in a variety of different markets. And if you look at many of our firms were in Russia for decades, that became untenable, right? So we have to look at other geographies that could become under stress.
Is there any evidence whatsoever that financial institutions are ever proactive about any of this? I mean, we've been talking about Russia for years and years and years and years and years. It is not a surprise to anyone. I don't know why we talked about the last 18 months as if it's surprising. It's not surprising. It's not a shock. It's a failure of leadership in Europe to see this one coming. Chancellor Merkel was warned about this repeatedly, didn't change the energy relationship in any way, shape or form. And financial institutions have been caught with their pants down in Russia. It's hardly a shock to anyone that this has happened. So why were they still there? And is there any reason to believe they're going to be proactive about issues like China? I'm not convinced. Are you?
Well, I am convinced that we are sensitive to the risks of U.S.-China tensions. It is the product of every conversation we have at our board meetings. Now, the question is, what do you do about it? And that's the same question the real economy is having. Lots of real economy CEOs are saying we should de-risk. Are they moving out? Not clear that that's happening.
When is the risk of stranded assets going to supersede the risk of losing out in profits?
In terms of China? Well, I'm not sure we're going to have stranded assets. We talk about stranded assets a lot with respect to climate change, but the timeline of that is very different from the way in which we do capital planning.
Tim, this was an education, a clinic. It always is. Tim Adams there of the Institute of International Finance. Tom, some difficult topics we've got to talk about for the next several years, I'm sure.
Well, that's the geopolitical tensions. As Mr. Adams mentions, the fragmentation seems to be the buzzword from Kristalina Georgieva. I'm worried about the fragmentation in America. And to me, the arch question here, moving from 30,000 banks to 4,200 banks, is where does that lead to? I'd go north of the border. What's wrong with the Canadian model? I mean, I'm fast, not the Swiss model of 3 banks to 2 banks, now to 1 bank.
I thought you were moving to Canada.
I don't think anyone wants the Swiss model, just to be clear.
Yeah, I mean, even the Swiss don't want the Swiss model.
They don't want the Swiss model, but I would suggest the hysteria of 1833 is no different than the hysteria of 2023 on all these banks, and do we really need them to find supervision and efficiency?
There is this big quest to preserve the regional banking model in the United States. I don't think that's going away anytime soon, Lisa.
A lot of people, and I really go back to Wendy Schiller at Brown University, when she said, in some ways, people's local bank tied them to their communities, and that this actually connected them politically and it connected them in a larger sense. Has that gone away, though, in an era of mobile banking? And this has been a big question, just underpinning some of the angst around regional banks.
I think a lot of people really are worried about their bank and can they get miles on their United Mileage Plus account or whatever. You know, pick the mileage thing. I think we're living in Tim Adams.
Exactly.
You know, when Tim Adams comes in the room, it's like Henry Clay. I mean, it's like the 19th century walks in the door. And frankly, in Diamond's letter, he alludes to this. We got to drag our sorry selves into the 21st century of banking, where Bramo's going, now, can we get miles? If we buy this through the bank, can we get 30,000 miles?
Why are you pitting this on me?
I think he wants United Airlines.
It's everybody, Lisa.
No kidding. United, seriously?
United.
And you're going to put that on me?
United is his big thing.
Yeah. United, it could be Chase, it could be whatever.
That's good.
Name your bank.
Good for you to name other institutions.
I've got my Tots vanity card.
Okay.
It's got Harry Kane's on the cover up. It's really good.
That's cool. Okay.
Yeah.
Anything else? No? Done?
The number?
Thanks.
Amy Wu Silverman of RBC is going to join us because CPI comes out in about 1 hour and 34 minutes.
The banking crisis has been contained, given that there's good access to liquidity in the strongest banks.
Unfortunately, there's more downside in the equity markets than there is upside today.
You need people to stop spending, you need credit to contract, and that's what slows the economy and brings down inflation.
The Fed wants to hike probably once, maybe twice more, but it's really torn because it's got these obvious troubles.
I think the landing could be quite a bit harder than many are discussing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from Washington, D.C. for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and on radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro in the nation's capital for the IMF World Bank spring meetings with you for the next several days from Washington. Equity futures right now on the S&P 500, just about positive on the S&P as we continue to count you down to the inflation report in the United States of America. That print 90 minutes away. After CPI through the rest of this week, the attention shifts to bank earnings in America. Tom, but first of all, 90 minutes away, we've got to deal with inflation up front.
Key CPI data, split it between core and headline. The adults are focusing on core. That's what we'll do, obviously, at 8:30. But there's much more than that. I love David Rosenberg's work in Toronto of parsing the inflation analysis into 20, 30, 40 lines. That takes time. We're not going to do that. Even Mike McKee can't do that at 8:31. But the idea of looking at the subsets of inflation will, I think, be a very rich study.
And then, Lisa, just on the horizon, in the distance, May 3rd, the Fed's next big call.
Yeah, how do they even weigh all of these data points, right? I mean, and we've talked about this, the subjectivity of data. So you could say you're data dependent, but what does that even mean when you can choose the data that you want to fit the narrative that you'd like to put out there?
God, I miss the cynicism.
Well, I mean,
I'm sorry.
Cynicism is just facts, so you can talk about the CPI.
I happen to agree with you.
Well, thank you.
Wholeheartedly.
I mean, honestly, today's CPI data, you can color the way you want. Perhaps, maybe we'll get an absolute read, hot or cold. But there's a question of where is the trajectory when the world changed with SNL, given what happened with Silicon Valley Bank and given what happened going forward. And this really is the angst underpinning the market and underpinning the Fed.
This phrase, data dependence, has become a crutch. It's how you don't answer questions. Well, we don't know where things are going. We'll be data dependent. But ultimately, the real question, Tom, is what data are you dependent on? And how much weight would you put on traditional indicators, CPI, GDP, NFP, payrolls?
Yes.
And how much weight would you put on these new indicators we've become very focused on? H8 data from the Federal Reserve and what's happening with bank lending?
I would parse this into a financial study, a real economy study, which we spend way too much time on, and then also now a bank financial study. So you have three broad narratives bouncing into each other like a proverbial Venn diagram, and they're dynamic. They change day to day. We need information on the real economy, we need information on the core financial data, and we need information, as you mentioned, on Federal Reserve details of the bank deposit flow.
The totality of the data, and hopefully we get some information, some clarity from the banks themselves. JP Morgan reporting earnings on Friday. We were due to have some earnings from First Republic tomorrow, on Thursday. We're not getting them on Thursday anymore. April 24th for the First Republic earnings report. Look out for that. I want to give you just a quick snapshot of the price action, and Lisa can give you the day ahead in just a moment. Equity futures right now positive by a little more than 0.1%. No drama here whatsoever. Yesterday was a total snooze on the S&P, closing totally unchanged. Yields just a little bit higher by a couple of basis points. 3.44 on a 10-year maturity. Just on a 2-year, Lisa, back above 4%, just higher by 3 basis points again at 4.05% this morning.
The tension of the possibility that the Fed is likely to hike on May 3rd, a 75% chance priced into the market, with the reality that this is a very quickly moving economy that is hard to see. 8:30 a.m., we try to get some visibility with U.S. CPI. There are two main components, I feel like, right now to the inflation discussion. There is the inflation readings, and then there is what's going on with respect to banking stress. This is one of them. Does this get upended by what we get starting Friday? Core is going to be key. 5.6% is the expected year-over-year number, up from the February read of 5.5%. How much does that really color the conversation when you strip out the more volatile food and energy categories? 10 a.m., the Bank of Canada. Tom was talking about moving to Canada and the Canadian banking system. I'm curious about their rate decision. They could potentially hold rates at 4.5% for the second straight meeting, moving against the ECB, moving against the Federal Reserve with a pause. What is the consequence of their signaling? How much do we see the market push back against that? And if there is acceptance, does this give a green light to the Fed to do the same? 2 p.m., FOMC meeting minutes. This is going to be really interesting because we're going to get a sense of how visceral the debate was between people saying the credit crisis that you're seeing with respect to Silicon Valley Bank is material and we need to respond to it by pausing, and how many people come out and say, ignore it, it is noise, let's go forward for the 50 basis point. How much was there a consensus around the 25 basis point that they actually got through? We do hear from Tom Barkin today and Mary Daly, both of the Fed.
Would you move to Canada?
I would, but Luke Kawa joined UBS just so he could get their Maple Leafs tickets.
Is that right?
Oh yeah, that's why.
I didn't realize you were talking about moving to Canada.
It's like sort of like England. There's like 5 big banks. That's it, and they're not in crisis. It's a really interesting debate, and a lot of people use Canada as a model that may be efficient and successful.
Lisa was talking about sending you to Canada.
I did not say that.
On this morning.
Well, I'm not going to Montreal because the Canadians are an embarrassment, but, talk to Rosenberg.
Okay. Amy Silverman joins us now, head of derivative strategy over at RBC Capital Markets. Amy, wonderful to catch up with you, and welcome to the programme as always. Amy, is this the calm before the storm?
I think so. I think it is. And for what it's worth, Tom can visit Toronto with me anytime, as I have to go there quite often. But, look, I think it's a bit of the calm before the storm because obviously we have CPI quite shortly. And then after that, we have earnings. And, the volatility right now, we have a sub-20 VIX is reflecting a little calm before the storm. I think that changes quite quickly. And I think if you actually get a cooler CPI and volatility comes down even further, that's probably an opportunity to buy because historically, the first few weeks of earnings is a great time to own volatility.
Amy, I want to go narrow with you on your expertise on the cross moments, and particularly this strange thing called skew. We're talking to Lisa Abramowicz about her newsletter. We're going for a toxic brew. I want to talk about a toxic Apple skew. Everybody's on board, big tech, and you're looking at their derivative dynamics. What do they say about the future of a big tech rally, a toxic Apple skew?
So, I'd say two things are really interesting right now in the options picture. The first is, while option prices are kind of high in financials, that skew is quite low. It is not showing any more bearish sentiment. You're getting exactly the opposite picture in big tech. So the option prices are not nearly as high on a relative basis as financials, but that skew is very expensive. There is that demand for downside. A simple explanation is people just have made a lot of money in tech so far. It's been this safe haven trade. So, of course, more demand for hedges. But also, it could point to further bearishness, particularly on earnings, where you start to get that new information. And remember, if Apple goes down, if Google goes down, if Meta goes down, the overall market goes down with it.
Amy, what's more important for you this week? Is it going to be what we get today at 8:30 a.m. with the CPI report, or is it going to be JP Morgan earnings kicking off on Friday?
I think this is probably the one time where I would say it's these financials earnings specifically rather than CPI, which obviously has been so core to everything. But, people are really going to be hanging on the words of every management team. JP Morgan, the large banks, obviously, but also the smaller regionals where when you kind of look into the derivatives market, again, that options positioning is still showing a lot of magnitude. So those implied moves going into earnings, SURP on the terminal, is showing you that we're still pricing nearly 3 times the expected move that you see over the historically last 8 quarters of these companies.
So how do you translate this into an equity call, bullish, bearish? We try to take the blunt tool of what this means for Fed rate hikes or not. But from your vantage point, if we find out and get a confirmation that we did see deposits tumble by the most in more than a decade at the biggest banks, as some people are expecting, or that there is a massive restriction in capital creation, how much does that color your view, make you bearish on certain sectors, push you toward others?
Look, the 2 most popular questions I get around how to structure trades is the first one is, how do I play a rebound in the regionals through KRE? And the second is, how do I hedge tech? And, those are the biggest questions I get in options right now. We look at KRE call spreads. We're looking for QQQ put spreads. But essentially, when you lead that back into equities, it's this question of an inflection point. Does this quarter become an inflection point? And if it does, what optionality is the best way to play that?
Amy, wonderful to get your thoughts, as always. Amy Wolf-Silverman there of RBC Capital Markets on the calm before the storm, the calm before CPI, the calm before earnings later on this week. And that's another guest that has suggested to this market, at least right now in this moment, that maybe the earnings from the banks, Lisa, more important than the data we've received on Friday for payrolls and CPI a little bit later this morning.
We were just talking about the importance of regional banks, and Jim Bianco pinged me over at Bianco Research and pointed out why it is so important to watch the health of these regional firms, that the majority of the workforce in the U.S. is employed by them, number one, and the 4,200 regional banks are best structured to meet their needs, and that let's say you get them to disappear. What happens? Do the big banks beef up in specific towns in Cincinnati and Toledo and basically go and try to serve all of these commercial realtors as well as all of the other businesses? Or do they just not get access to funding?
People were watching in Cincinnati going, Bramo's conflating Cincinnati with Toledo, the Reds with the Mud Hens? I don't think so.
Thank you for that insight, Tom.
Thank you.
You get smart comments on the Bloomberg. This is what I get. To be clear, he won't come south of 50th, but he'll move to Canada. That was a message that I got on the Bloomberg terminal about you moments ago.
Just to give you a little vignette on this, I used to buy my hockey sticks at Maple Leaf Gardens just because it was cool. And to go into the old Maple Leaf Gardens, John, and stand on the top, I'm sure there's an English equivalent. It was like St. Peter's in Rome. It was the old.
That's what it meant to you?
Sitting at the top, looking down on that Canadian history was just, I can't say.
It's like me at the San Siro
sure there's
in Milan.
Yeah.
Same thing.
I
feels,
so. That's before Zava went to AFC Richmond, but that's a different story.
Yeah. Okay, thanks for that.
Thank you.
I'm picturing him at the dinner table being like, this is like Rome, listen to me in my proclamation, and everyone just sort of shrinking.
Is that what dinner
seats.
time's like at Casa Keene?
Dinner time.
Right? Do you sit around the table together?
And argue like cats and dogs.
Yeah.
Argue. It's very constructive. I mean,
That's what we did.
Actually.
That's what we did as children.
Crazy.
Yeah. But then there was a cut-off. It wasn't allowed to carry on through the night. Only at the dinner table. It couldn't carry on to the following morning. You had to, let it go. Let it go. Absolutely, you had to let it go. Then you started again the following day.
Exactly. What does it mean to let
it go? At the dinner table.
Exactly.
About yesterday. Futures on the S&P.
Is Toxic Brew winning on the newsletter?
Positive 1/10%. We should do a survey ourselves, a poll, yeah. Let's do a poll
that's a great idea.
On names for it. Okay, from Washington, this is Bloomberg.
Casa Keene. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. The Biden administration is proposing a tough crackdown on auto pollution. Tailpipe emission limits will be so strict they will compel automakers to ensure 2 out of every 3 cars sold in 2032 are electric models. Still, there's questions whether car companies can fulfill the fleet-wide limits on carbon dioxide and smog-forming pollution. In other news this morning, officials in the Fed, they are signaling that there's a divide over raising interest rates. Well, New York Fed President John Williams says there's still more work to be done to bring down inflation. Meanwhile, Chicago Fed President Austin Goolsbee became the first official to suggest that policymakers may need to hold off on further hikes for now. We get the latest numbers on consumer prices at 8:30 New York time. Donald Trump wants a 4-week delay in the start of a civil trial over his alleged rape of author Jean Carroll. Now, his lawyer says a cooling off period is necessary following his indictment in the case of hush money payments. The trial in the Carroll case is due to start April 25th. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So I've not really seen evidence at this stage suggesting a contraction in credit, although that is a possibility. I believe our banking system remains strong and resilient, so I'm not anticipating a downturn in the economy, although, of course, that remains a risk.
Welcome to the world of politics. Janet Yellen, the US Treasury Secretary, yesterday saying, quote, "I've not really seen evidence at this stage suggesting a contraction in credit." Yet on Friday there was exactly that. Lisa, evidence of a contraction in credit. What did you make of those comments yesterday?
I viewed it as a political kind of speech. And I view this also as her trying to parse out how much to fortify confidence in the financial system rather than reintroduce more risk. I did not view this as an accurate assessment of where we are or some sort of signaling. And I don't think anyone did. No one came away from this and said, all right, it's all clear. I guess we can just,
agree with the Treasury Secretary. The U.S. economy is doing exceptionally well as banks fail weekend after weekend over the last month.
It's not just the bank failures. It's also the fact that you saw the biggest 2-week contraction in commercial lending
ever.
I mean, that basically speaks to something.
And yet, Tom, she does not see signs of a contraction in credit. No evidence of it.
She's not like a normal Secretary of Treasury. We forget that Mnuchin, Hollywood producer, wheeler-dealer guy, is far more towards maybe John Connolly of Texas in the 60s. Yellen is a real outlier. And when you hear a speech like that, she's still struggling with how do secretaries of Treasury actually convey an administration
Did you just call Mnuchin a wheeler-dealer Hollywood guy?
He's a Hollywood guy. You know where I first interviewed him? He was a
dealer, Hollywood guy.
When I first interviewed Mr. Avatar, he was in an art gallery.
Oh, he's Mr.
in the
Avatar
Hamptons.
now. Okay, wonderful.
Yeah, he's a great guy. And may I say, he really grew, and he really got used to the Treasury dialogue as they went from crisis to crisis in the Trump administration. First time I interviewed Steve Mnuchin was on a summer afternoon in a Hamptons gallery. I mean, that's not like Janet Yellen.
I understand he tunes in time to time. Good morning, Secretary Mnuchin. I wonder what he thinks of that.
I don't know. I didn't watch the new Avatar.
It's really good. I liked it.
Did you like it?
Yeah, it was really good.
I watched it. It's just too long.
It's like 4 hours long.
Whatever.
Right?
It took 2 hours to get started.
But it was good, though, no?
Yeah, it was good.
Okay.
But it took 2 hours to get going.
All right, fine.
It's just,
are we ready?
Yeah, we are. We were ready a few minutes ago.
And this is going to be really, really interesting. I'm serious about this in that we have John Ferro here, who is posh and living in the United Kingdom.
So posh.
And Anne-Marie Horgan joins us now, Bloomberg social correspondent here. And there was a president getting off the plane. I saw Phil Mattingly on CNN going back to the mother country to see the president in Ireland. Explain the distance.
He's in Northern Ireland.
Okay, Northern, Southern, Western Ireland, I don't care. The answer is the distance.
There's a big difference.
The difference from Dublin to Liverpool is 117 miles. But the cultural difference is he meets with the Prime Minister of the United Kingdom. Ireland, United Kingdom, and a kid from Scranton. There's a real toxic brew here, isn't there?
There certainly is. And if you look what members of the DUP of Northern Ireland are saying is Arlene Foster, a dame, is coming out and saying current U.S. President Joe Biden is anti-British. And that's why you see the White House head for National Security Council of Europe, Amanda Sloat, saying he is certainly not anti-British. There's a deep connection between the United States and the U.K. The president wants to make sure he's growing this relationship. And he's here to mark 25 years of the Good Friday Agreement and to have discussions about Ukraine and the economy with the U.K. and the U.S. But the heart of it is that this is a president who likes to talk a lot about his Irish roots. And most of this trip is actually him placing back his lineage. And he's going to be almost on a family tour after he meets with Rishi Sunak and gives a number of speeches and a number of meetings with party leaders.
What's he done to grow the relationship with the UK?
Well, that's a great question because the UK really wants right now a free trade agreement, and that has been on ice since the Trump administration.
That's been pushed back again now, right?
Yes. And, Jonathan, you know this very well, obviously. When Brexit was being hallmarked in the United Kingdom, the crown jewel of that was going to be a free trade agreement outside the European Union with the United States, and the U.S. has not delivered at all on that part of the bargain.
Why?
Well, there's a number of reasons why. It is just not a priority, though, for this administration. It is not a priority to have a free trade agreement with the United Kingdom. For the UK, the U.S. would be a huge win. But for the U.S., is the United Kingdom that massive of a trade partner? but it is an important relationship. To the White House's defense on this matter, Amanda Sloat had said Rishi Sunak, the UK Prime Minister, will be coming to Washington in June, and that's where they'll be discussing more economic issues like a free trade agreement.
Are they going to discuss the comments from Macron over the last week?
Well, that potentially will be one. We already heard Liz Truss, the former UK Prime Minister, coming out and really having her own view on that, pushing up against Emmanuel Macron, who's taking a lot of fire right now, not just from U.S. politicians, but politicians in Europe. But also another huge point, not just Macron, but these leaked documents. Yeah. This is going to overshadow every meeting the President of the United States has from here on, at least the next 6 months.
Well, that's where I wanted to go, actually, because we see dueling reports. Some people saying we don't know yet, this isn't clear, to see what the extent of this is and how much this could potentially disrupt relationships. We've seen South Korea come out and reaffirm the strength of the U.S.-South Korean ties. How much in closed-door conversations has this disrupted the willingness of allies to share information?
Well, they're concerned not just about sharing of information, especially when you look at the Five Eyes and these intelligence groups, but also the fact that the United States is once again spying on allies is a concern that you hear foreign officials talk about. The one thing you don't see is it's not happening so much in public. These conversations, allies are using back channels to air their grievances, I would say, with the administration. They're not doing it in public. South Korea is an interesting moment, though, because the head of the country will be coming to the United States for a state visit, but the opposition is saying the U.S. is infringing on our sovereignty by spying on us. So it's a difficult moment, and what these leaked documents have done is put these leaders in very difficult positions as they're dealing with the White House.
The public comments have been, we're investigating, we don't know everything yet, just wait, nobody's waiting. When they talk to the actual, the allies, what kind of guidance do you hear them giving in terms of what their understanding of who leaked the documents when and how significant the leak is?
We just don't know yet. And I don't think they actually even understand how significant the leak is, because the comments, and we had the first comments yesterday from Lloyd Austin, the defense secretary, the first public comments, they're pretty muted and they don't give much details. And it's pretty much like, we are waiting and we'll update you when we find out more.
Is that because they don't know?
I think that's a number of reasons. They probably don't want to come out yet until they have all of their ducks in a row, and they probably still are investigating it. But
I get the feeling they just aren't really aware of what documents are out there at the moment.
Well, I guess the concern is, is there potential for more documents to be leaked? How can they come out and say, we've put this to bed, we've wrapped it up, and then potentially they can get slapped in the face?
AMH, thanks for having us in Washington.
Oh, thanks.
I appreciate it. Thank you. Thank you. TK, what a saga for this White House right now.
It is. Oh, the leaks, I'm with Anne-Marie on this. It overwhelms every discussion. I mean, I can make jokes about Brexit and British tariffs like on Walker's shortbreads. That's a scandal what I have to pay.
Is there a tariff on that?
Free trade agreement.
Didn't know that. Wow.
You know what? Jokes aren't in place here. This is really serious stuff. I believe we have General Kimmett coming up on this in a bit. But to Anne-Marie's point, you just go and let it phase out because you don't know what the next document or next event is.
You joke about food tariffs, shortbread, but actually food standards is the big issue if you ever wanted to come to some kind of free trade agreement with the United States.
I don't mean to make little of it,
These standards are a little bit more, let's say, robust in the United Kingdom around food.
A discussion around UK tomatoes and their eggs.
It's more like
it's
about what you do with your chicken and stuff like,
you know, how good.
I know, we're not going to have a conversation about that. No,
they
just are. You know, that's not really a conversation. That would end pretty quickly.
Okay, we're just going to skip barrier here.
Adam Posen's going to be joining us shortly of the Peterson Institute for International Economics. I'm looking forward to that conversation. He's here in Washington alongside us in about 5 minutes' time. Equity futures positive by 0.1% on the S&P 500. Yields unchanged on a 10-year. CPI data, the inflation report, 64 minutes away. I always say the greatest quotes are in the commercial break, but I won't share them.
On it like a sports
We should one day. From Washington, D.C., this is Bloomberg Surveillance, 60 minutes away from the CPI report, the inflation report in America. Going into it, your equity market shaping up as follows on the S&P 500 and on the NASDAQ. The NASDAQ is just a little bit softer, weaker yesterday too, down by 0.1%. Firmer on the S&P, up by a little more than 0.1% on the S&P 500. Pretty muted price action going into another important read on inflation. Then on to earnings in America, with JP Morgan reporting results on Friday. In the bond market, the 2-year reclaiming 4%, a 4 handle on a 2-year yield, 4.0372%. Yields just a touch higher now by a basis point, a little more than a basis point so far this morning. To look over to Europe, remember May 3rd for the Federal Reserve, May 4th for the ECB. The May 3rd rate hike from the Federal Reserve could get rubber stamped a little bit later this morning. Barring any more banking stress, 109.27 is where euro dollar is. Firmer by a little more than 0.1%. Tom, that's a slightly stronger euro this morning, a weaker dollar.
Huge debate on a weaker dollar, of course, an interest rate dynamic. We heard Ibrahim Rabari frame out not months but years out, very tentatively, but with respect to where could we be 3 to 5 years out. And he's modeling stronger yen 110, perhaps modeling stronger euro 130. These are big moves, but it's what the financial media doesn't do. We look short term, 1 quarter, 2 quarters, maybe a year out.
1 week, 2 weeks.
The adults are looking out 3 years, 5 years.
Lisa promised to pay for dinner later. And for that reason, we have to promote her newsletter. Subscribe. Subscribe. How many times do I have to say subscribe? Just subscribe.
You're doing great, by the way. She bribed me. All right, fine, I'll get this done.
Bloomberg.com/surveillance for the Bramo Toxic Brew, the Daily Toxic Brew, which I think is going to work, and we're going to rebrand that without Lisa knowing about it.
I think that if I don't know about it, I'd have to have my head in the sand. That's all I can say, because I think you've telegraphed it just fine.
There we go. I think that works, Tom. Looking forward to the latest edition.
Today. Yeah, in there will be comments today with our next guest. Adam Posen with us, and it's always an annual visit at these meetings of the IMF and the World Bank. He's president of the Peterson Institute of International Economics. He is, without question, with Richard Clarida, one of the leaders in thinking about Germany in the United States of America. Dr. Posen joins us this morning. John's going to talk to you about your wonderful essay on the simplistic static analysis of manufacturing in America. I want to go to the mathiness you learned. You were at Brooklyn High School a million years ago, and they said, don't look out 5 years. And then you went off to undergraduate. Don't look out 5 years. Then you did your PhD work, and they said, don't look out 5 years. And here's the International Monetary Fund with a 5-year model of 3% growth. Can people like you look out 5 years?
We can look, but we may not see. I think, Tom, the IMF is making a judgment call, which is within their rights. And I think it's a reasonable judgment call, but unfortunately, I think it buries the lead, which is that we're going to get a goosing of short-term growth in the large economies, in the U.S. and China, in Europe, because there's going to be public spending on defense and on green. And there's going to be a continued falling off of growth in the poor economies, who are going to be forced to choose between U.S. and China. And for reasons, very good report put out by the IMF recently. I know you covered, very good report by the World Bank recently. You've covered my stuff. The spillovers on growth for the developing world from the U.S.-China conflict and the subsidies race between Europe and U.S. is very bad.
What to me is critical here, and David Folkerts-Landau of Deutsche Bank with some serious publishing with Dooley years ago, echoed what you said the day after Putin invaded Ukraine. So if we have the fiscal stimulus that Dr. Folkerts-Landau is talking about, you're talking about right now, and we dovetail that into your colleague Olivier Blanchard's phrase, fiscal space, does the United States or Bolivia that we mentioned the other day, do they have fiscal space to act given the present traumas?
So you may have seen I hosted a debate or a conversation between Olivier and Larry Summers on PIE.com a few weeks ago on this very topic. And where Olivier, Larry, and I, more importantly, Olivier and Larry, came down was that this kind of sustained fiscal expansion and possibly some inflation premium that continues going forward will decrease the amount of fiscal space. Olivier's fiscal space, rightly, is about the gap between real interest rates and real growth. And that's been very large for a long time. This is probably going to cut that by a third to a half. That doesn't mean the U.S. doesn't have fiscal space, but it means that we're more at risk than we've been for a very long time, and a bad shock to productivity, to revenue, or to interest rates could put us quickly into bad space. But additionally, if R-star, the shorthand for this, basically goes up, meaning that the gap between interest rates and growth shrinks, the Bolivias, the Sri Lankas, the Pakistans, lots of Central America, lots of South Asia, lots of Africa, they lose fiscal space.
When you have these discussions, is there a tipping point for 10-year yield, say, for borrowing costs in the United States, after which the current fiscal model becomes untenable?
Yes and no. Sorry to do it that way, Lisa. The yes is you can do some very fancy mathy stuff. Jeremy Zettelmeyer, now the head of Bruegel, who used to be at the IMF, and Olivier and others have worked on this, and you have to do simulations. But cold bottom line, the odds of your tipping go up, and probably go up non-linearly the closer you get to R minus G being 0, because this is the math. I mean, the basic math. Once you're above, once that R minus G turns positive, meaning interest rates are outpacing growth, that's when the bad debt dynamics kick in. That's when, if you have debt to GDP, it's over 100%, it kicks in. Now, it's not a tipping point that happens, going back to where Tom started this week, this month. Maybe for Bolivia, not for the U.S. But if that turns out to be the case, that being rates above growth rates for 6 months, a year, then you start getting serious.
The bad politics has started. You mentioned that, the subsidies race between Europe and the United States. I still don't think this is getting enough coverage. You said it's very bad. Can you paint a picture as to why this is so bad?
So, as it happens, Olivier and I and some of our trade experts from Peterson, Chad Bown and Jeff Schott, were meeting with a European finance minister last night about this very issue. Basically, the problem with subsidies in trade is that it ends up being not just wasteful, that's bad, but as I've tried to argue in my article, and as history shows us, it escalates very quickly. And this is what we're seeing. The U.S. puts out this IRA, which includes huge subsidies for particular companies, not just subsidies for green tech, not just subsidies for R&D. That would be nice, but subsidies for particular companies on a criteria of they have to be producing in the U.S. and mostly they have to be U.S. headquartered. And so then Europe says, okay, well, we'll do subsidies in retaliation. And then the UK says, already has, one of the opposition politicians, Miliband, came out and said, you know, we got to keep up with this. We're not going to be left behind. We had the Indian finance minister at PIE on Monday, and she said, we're going to do subsidies. And so what you end up with is like an arms race. Everybody builds up. Nobody gains economy of scale. The competitive basis for having the winning company, say based on better technology, more efficient processes, doesn't win because you're subsidizing here and you're subsidizing here. And France says, we're not going to buy American, and America says, we're not going to buy French. And so you end up with this huge on-balance sheet obligation to the fiscal, to go back to where Lisa was. And one of the worst things about this is open-ended. So the way the U.S. passed the latest round of subsidies, it's driven by the consumer. It's how much you produce. It's not, oh, we're going to get to this level. You produce more, you get more subsidies. So this becomes a fiscal issue, as well as you run in place to just get to the same spot. And then finally, it's totally discriminatory against the rest of the world, because basically China, the EU, and the US can afford to do this. India can pretend to afford to do this. UK can pretend. And the rest of the world, you're out of luck.
It's done under the guise of supply chain resiliency.
Yeah.
And these phrases get thrown around and they take on a life of their own. It's almost just the truth. You have to get more resiliency into the supply chain, and that means you have to bring it home.
Yeah.
You've dismissed that straight up. I think you've said it's proven to be a fallacy through economic history, and I can think of several failed socialist communist states that have tried to do the same thing, and it's difficult to do. Is the United States, Europe, China, even if they have access to the funds, they can afford to do it? Who says it's going to be a success?
Well, thank you. I agree. You know, there is a legitimate question to be raised. As private supply chains have risen organically, individual purchasing managers saying, I got an order from the CFO to cut costs 10%, so I'll outsource this. Oh, I've now outsourced this, so I know somebody else. You know, there's a reasonable public policy interest in saying, let's not overdo that. But that's very different from saying bringing it home is safer. You know, it's the same logic as your investor watchers say. Diversification matters. I think you mentioned all the communist countries. This is part of what I've been arguing. I mean, you look at Russia. Russia has spent 20 years trying to make itself self-sufficient just so it could go do things like invade Ukraine and not worry about it. And like the U.S., like China, it's huge, but it still doesn't work. It ends up backfiring. You end up with a corrupt industrial complex that doesn't give you what you need.
John, British headline, 2012, 11 years ago, business group economist to replace Archdove Posey at Bank of England. Do you have any advice, former MPC member, for Megan Green as she is anointed to, there'll be a coronation as she moves to the Bank of England?
Oh, I hadn't heard the news. Congratulations to Megan. That's great. You know, the external members, including Catherine Mann, my former colleague, who's now on at the Bank of England, have a good record of genuinely giving independent thought. And you mentioned me as being characterized as the archdove a decade or 11 years ago. Of course, now I'm considered a hawk because I'm telling the Bank of England, you guys are whistling fantasies. Inflation's not coming down. So be data-driven, and everything will be okay. But I hadn't heard about Megan. That's great.
Adam, the external model at the Bank of England on the MPC, it's different to, say, the Federal Reserve. Why is that so important, and what lessons can we take from that? Mohammed El-Erin was talking to Tom and I about this on Friday. He said that the MPC model of having external members is helpful. Do you think it is?
I think it is. I fear it's not as helpful as it should be because sort of you look back at what the Bank of England has done or others with an external model versus what the Fed has done, and the differences aren't as great as I would like to think. But I do feel it's been important for the bank, both in terms of legitimacy, just that you end up having more split votes and more open discussion and debate, which is better for the public sense that this is hard, but they're taking it seriously. And occasionally you get things right a little faster because the external member's squeaky. You used to have, and still probably do, my former colleague Danny Blanchflower, who was quite squeaky, but also...
Blanchflower was the worst since Henry VIII, I think.
But he, in this particular instance, he was right. And I think history has shown I was probably right on some of the stuff I squeaked about while I was there. So it's useful.
Adam, a clinic, as always. Thank you, sir. It's good to hear from you. Adam Posen there of the Peterson Institute for International Economics. Live from Washington this morning. Good morning. Inflation data in America just around the corner.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Last month, policymakers shrugged off bank failures to deliver a 1/4 percentage point rate hike. Today at 2 p.m. in Washington, we find out the thought process behind their decision when the Federal Reserve releases minutes from that meeting. The March rate hike brought their benchmark rate to a range of 4.75 to 5%. China indicated it will maintain pressure on Taiwan following its large-scale military drills. The maneuvers began after Taiwan's President Tsai Ing-wen met last week with U.S. House Speaker Kevin McCarthy in California. A Chinese spokesman said, quote, "We will not leave any room for any form of Taiwan separatist activities." Senator Tim Scott of South Carolina is one step closer toward challenging Donald Trump for the Republican presidential nomination. Bloomberg's learned that Scott is launching an exploratory committee that would allow him to start raising money for a campaign. He's visiting several early voting states this week. Bed Bath & Beyond says it's raised more than $48 million in an equity offering as it tries to avert bankruptcy. Now, the home goods retailer's goal is to raise $300 million by April 26th. Shares have plunged in recent weeks amid growing pessimism about the Bed Bath & Beyond's outlook. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Fragmentation risks have risen quite sharply over the last 5 years and have been accentuated by the war in Ukraine. If those risks rise, then Asia risks to lose the most among all the regions in the world.
That was Krishna Srinivasan, the Asia-Pacific director at the IMF. I have to say, I have to keep going back to this. The IMF commentary of the last couple of days, so gloomy. And we can pick up on some of that for you through the week as we cover the IMF World Bank spring meetings down here in Washington, D.C. Also staying on top of the data, the CPI data, the latest report comes out in about 43 minutes' time. Going into it, equity futures, Tom, still positive by 0.2% on the S&P 500. Yields just about unchanged on a 10-year, 343.93.
Right now in Washington, in the IMF spring meetings, we digress. Joining us now in his Washington is General Mark Kimmett. Yes, the former Assistant Secretary of State for Political and Military Affairs, but he has been a terrific advisor to Bloomberg Surveillance on the complexities of military in this modern era. General Kimmett, thank you so much for joining Bloomberg Surveillance.
Thanks, Tom.
Today. I want to go right now to something dovetailed. It's a bit off the script here of the themes out there, and I think it's been ignored in the American press. We are reaffirming our position in the Pacific Rim by a $100 million 12-month capital commitment to the Philippines in 4 Navy Army bases. I think most of America is ignorant of the Army commitment in World War II, what happened north of Manila, the bravery that was done there. And what I'd like to know from you is the importance of this projection by the Pentagon to a new Pacific Rim strategy, Army and Navy.
Look, I don't want to sound trite, but you and I, Tom, grew up when the Iron Curtain was up. I think this generation is going to be growing up with the bamboo curtain. We're setting a curtain that ranges from Korea to the Philippines to Japan down to Australia to try to contain the hegemonic behavior of China militarily. Cooperation and competition going on economically, but there is a significant concern about the hegemonic aspirations of China, and that's what the military is setting up.
Our guests talk about a substantial increase of Pentagon spending to GDP. You're the best general we have linking in financial matters. It's widely understood that Kimmett owns the high ground there. Do we have the will to expand Pentagon spending to GDP?
Well, I may know a lot about the military, but that's more of a political question. The issue is, can the president, can the Pentagon make the argument to Congress and to the American people that raising of GDP is necessary at a time when, quite candidly, the federal budget is under significant duress from other expenditure programs, entitlement programs. I hope they do. I think it's necessary, but that's a tough sell to make these days.
General, I keep going back to what Peter Cheer, a commentator, said on this show a couple of days ago, when he said that this is probably the most perilous and fraught moment geopolitically that he's experienced, and that his generals who work with him, his former generals, have experienced in a very long time. Do you agree? And is it really focused in China, or is it broader?
Well, first of all, he must be quite young, because the threats that we faced when I was a young officer were far more significant, whether it was the Soviet Union, the impacts of the post-Vietnam period, the Russian-Soviet interference in both Africa, Latin America, Central America. There were a significant number of challenges there, not to mention we had a population that was absolutely unsupportive of the military writ large. Yes, we have challenges today, but I'm convinced that the U.S. military is up to those challenges, whether it's the Army, Navy, Air Force, or Marines. We need to modernize, we need to expand, but our soldiers are ready.
How does that dovetail into the leaks, the national security leaks that we've seen? Perhaps the military is ready, but is the intelligence infrastructure, is the cyber sort of security in place to really support them?
I certainly hope so. I was never concerned about the intelligence products that we were getting from DIA, the human intelligence, the signals intelligence, the military intelligence, cyber. I think we're at a situation, Lisa, where we don't know what we don't know. But the fact that Russia has not been able to execute a successful cybersecurity operation against Ukraine, I think tells everyone that we're probably ahead of where we should be. I'm just not competent to answer that question.
But the bigger takeaway for a lot of people is that the U.S. is spying on its allies. That
as we always have.
Right. So this is sort of not a surprise, and perhaps shouldn't be. But that also that the U.S. could be a sieve, right? That there could be breaches here if other countries share intelligence. How concerning is that to you? How much is that what you're focused on?
Yeah, that's probably the most important issue there. The issue of allies spying on allies, I mean, that's something that's understood. This is not a surprise. It's just an embarrassment when it gets into the general public. With regards to your other questions, particularly what we call the Five Eyes, countries that we share with, that is a significant threat to the relationships, because Very simply, it reduces the intelligence flows. The other countries are much better than we are in certain areas, but if they don't want to share it because they can't trust us, that's going to have a ground effect.
I want to talk about the United States allies. Europe has been a weak link when it came to Russia over the last decade, particularly Germany. Germany was warned time and time again about the energy dependence it had on Russia and didn't do enough to back away, and we've had to deal with that in the last 12 months. Now we're dealing with China, and some people might make the same accusation that Europe once again is a weak link, and I would bring up the comments from the French president, the French leader over the last week, and as an example of that. You've talked about the hegemonic aspirations of China and the risk around that. For the United States to be an effective hegemon on the global stage, both willing and able, it needs to bring its allies with it, the Europeans. Are you seeing much evidence of that when it comes to China?
Well, with regards to China, I'm more concerned that the relationships we have are the strong links with Australia, Korea, Japan, the Philippines. That's the front line. The supporting line comes out of Europe. So while Europe is important, particularly with regards to the economic cooperation or economic enforcement when China violates WTO, I'm more concerned that we've got it right with the allies on the front lines, and then those in the second tier, the Europeans. That's important, but less important.
Give us a window into China. Stilwell was over there a long time ago, and it was basically total chaos. Marshall, retiring, had to fly over there on an emergency basis and try to figure out the new China. Has anything changed in 70 years? Do we have an intelligence basis there where we can be more confident of our actions? Or is there that cacophony that Stilwell and Marshall faced?
Well, first of all, I'm not an intelligence expert, but I sure know there are a lot of people in this town that know China well. In terms of the intelligence assets we have on the ground, if I knew what they were, I couldn't tell you that. But I think we've got a fairly good picture of what's happening in China. This
isn't a mystery like Gorbachev in Russia, where we had really difficult intelligence.
The problem that we have with intelligence is we're very, very good about assessing capabilities, what they've got, how many tanks they've got, how many planes they've got, how many soldiers they have. The hard part for the intelligence experts is determining intentions. What are they going to do with all of those capabilities? I think that's a conundrum that's been going on for years and years. One can only hope that when it comes to China, we can find some manner in which we can come to some sort of, I hate to keep using these words coming out of the Cold War, but some sort of perestroika or some sort of détente, because it's clear that China has I work in the Middle East. You can't swing a dead cat without hitting a Chinese businessman on a daily basis.
May we quote you on that?
You may. They're out there. They're pushing hard. They're pushing hard economically, as we saw with the agreement between the Saudis and the Iranians. They want to play heavily in a diplomatic field. We just got to make sure in the military that we can contain their military aspirations.
You've made a series of personal assessments about their intentions. What about Taiwan specifically?
What about
Taiwan specifically?
A tough policy issue. I think the Chinese, regardless of what we're seeing with all the noise in the air and on the sea, they're taking the long view. They believe that eventually Taiwan will return to the People's Republic of China. They're not in a hurry. I think militarily they know that trying to invade and occupy Taiwan would be an absolute disaster, but they've got time.
General, we appreciate your time this morning. Thank you, sir.
Thank you.
Fantastic. General Mark Kimmett there, the former Assistant Secretary of State for Political and Military Affairs. Tom, fantastic conversation.
It's a conversation that dovetails 3 or 4 dynamics. What's so important here for particularly younger people forward, there's no static analysis here. It's dynamic analysis of politics, military, and economics. Just can't look at it with simplistic phrases.
We've got to push forward now to the CPI report, the inflation data coming out a little bit later this morning, about 34 minutes away. Coming into that, equity futures are positive by 0.2% on the S&P 500. Yields a little bit higher by a couple of basis points. Your 10-year, 344.68.
You look at the disconnect between equity markets and bond markets, both telling you extremely different things, and I think it's a little puzzling out there.
For the Fed, the more near-term pressing issue is that you'll still have 3 months or so at least of pretty consistently strong inflation prints.
The Fed's going to ease only if something breaks.
I think the market is very much already pricing in a soft landing.
The market is clearly not pricing in a recession, but neither is it pricing in a soft landing, and it's pricing in a wait and see what happens.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. The spring meetings of the IMF and World Bank from Washington today. And all I can say is right now, no one cares about the IMF meetings or the World Bank gatherings as well. John, in 29 minutes, it's about one thing and one thing only: inflation in America.
Can we put the no one cares in our promo for our coverage through the week? That'll work.
Actually, that would be great for Bramo's newsletter.
Nobody cares. That's rude, Tom. That is rude.
Lovely.
That is rude, Bramo. I'm not on board. Equity futures right now on the S&P 500 just about positive, as Tom pointed out, about 29 minutes from now, the CPI report in America. Look at payrolls on Friday, green light to hike on May 3rd for the Federal Reserve. CPI a little bit later this morning, likely expected to be a green light to hike for the Federal Reserve. As you guys at home know, though, this is more than just about CPI and payrolls. It's about the banking stress of the last month or so. And that might be a reason to pause, to have a bit more patience. And I would suggest that that was the argument that the Chicago Fed president made yesterday, Tom, in his speech.
Austin Goolsbee with a real splash. I'm going to call it a maiden speech, and that it was really picked up by the media. I saw one place called him the Democratic president from, the service with the Obama administration. Forgetting about Goolsbee and the politics of it, what I would suggest is this is an inflation report of a massively data-dependent Fed. I think we can't say enough of the urgency for them to glean data of these many narratives discussed here in Washington.
The reason I enjoyed that speech from Goolsbee yesterday certainly wasn't because of the politics, certainly not that. And it wasn't just because of the conclusion. It wasn't that either. It was just very well thought out in a very, very simple fashion, and ultimately emphasised that he doesn't think the policy is in conflict for very, very obvious reasons. If you look at the banking stress that we've seen over the last month, you can acknowledge that may well be a substitute for what we're trying to achieve on the monetary policy side. No real evidence that those two things are in conflict. In fact, some people might suggest this is evidence of a feature and not a bug for the Federal Reserve effort. They want financial conditions to tighten, certainly not in a dirty way like the way we've seen last month, but ultimately this is the direction they're trying to push things through.
And Lisa, this is the strength of the Federal Reserve System. Loretta Mester of Cleveland, Barnard, first-rate mathematics, very sequential, very concision in her mathematics, and Goolsbee taking a much more holistic Chicago, and again, not the Chicago of Randall Krosner, the Chicago of Gary Becker, a more social view of what the Fed can do. This is every speech is different.
We don't know what data we're looking at, number one. We don't know where we're heading in terms of the inflationary environment, let's say post-pandemic. And they're basically reflecting those unknowns. I'm wondering if you wonder about banking stress, is that truly disinflationary? We don't know that either, because on certain margins it could be stagflationary. So how do you put these pieces together to understand at a time when still inflation is too hot? And today's core number, which we're going to get in about 36 minutes, could show that it's actually accelerating when it looks to stripping out food and energy.
John, year over year.
Correct.
Yeah, let's do the data right now. 4.05% of the 2-year. That's what I'm going to watch here at 8:30, the dynamic of the 2-year.
Just last week, Tom, we were in the 360s. The 360s on a 2-year, now we're north of 4% again. And this is what I think a lot of people are grappling with, wrestling with at the moment. Where's the signal? Where's the noise? Is the signal or the noise in the data misses, a string of them through the whole of last week, or is the signal the noise, the payrolls report, which came in pretty robust and resilient? And we'll be asking the same question when we get CPI again in about 26 minutes' time. What is more important here? What we learned on Friday, together with what we will learn this morning, or the bank lending data, the look at that we've had so far, which is not a great deal of depth, but ultimately it's all we've got, which suggests you are seeing some tightening.
The confusion for our listeners and viewers is Holland Horst Clark at Citigroup looking for 1 or 2 rate increases with a substantial nominal GDP. And an hour and a half later, Michael Darda of Roth MKM going completely the other way, looking for, Lisa, diminished real GDP, diminished inflation, and a real squeezing of that animal spirit of America.
I don't get the sense that the daylight between both polls of
Jim
this
Bianco
debate,
has said that.
I don't think that they're getting closer together. So what's going to be the determining feature where we
John,
know
what's the determining
where we're
feature
at?
before we get to Victoria?
It's what it always is, time and data. Time's the obvious one, and data's going to resolve this. Now, in early May, when the Federal Reserve meets, if you get the senior loan officer opinion survey and it doesn't show a dramatic tightening in standards relative to what we got last time around, I think a lot of people might sit here and say, coast is clear. I would say you've got to wait for the one after that this one isn't sufficient. It will take time, and maybe it will take getting through the whole of this summer to find out what happens here. Now, if you ask a lot of economists at the moment, what is the long and variable lags of a banking shock, I think a lot of people would say you'd expect it to happen pretty quickly. So let's see what the data looks like, which again is why you get people like Goolsbee saying, patience, wait, let's see what this looks like. And I do think the Fed has the benefit of patience. If you've got a year-end dot of 5.1% and you're only one interest rate hike away from that, that's pretty good news, isn't it? To be fair, you're pretty close to what you think terminal is. You have the luxury of time on your side in a way that they didn't 6 months ago. The bigger problem for me, Tom, for the Federal Reserve would have been if this banking issue had happened 6 months ago with inflation much more elevated and we were still debating 50, 75 basis point hikes and they were signalling they're still some way away from the terminal rate. This is a different environment now. They've done a lot of work. They moved really quickly and now they get the luxury compared to the lack thereof a year ago of having a bit of patience and time on their
with
side.
General Kimmett here moments ago, I'll use a military phrase, expect the unexpected, which is maybe what we're going to see here in 23 minutes. On the equity markets and dovetailing all this narrative blather, Victoria Fernandez joins us, Chief Market Strategist, Head of Blather Study at Crossmark Global Investments. Victoria, I've heard this from so many people contacting us, emails, the newsletter, everything. Heads are spinning over the many narratives. How do you invest in equities in a measured way 3 years out, given the cacophony of narratives in 2023?
Well, look, Tom, I think when you're looking at a portfolio and you're looking at the data, because we're data dependent too, right? It's not just the Fed. And I know your conversations earlier were about the bias in choosing the data that fits your own narrative. But if we take a larger look at that and look at the whole picture, you're still in a time period, like I had said maybe 6 weeks ago or so, of confusion. You have bears, you have bulls. They're both adamant. You have a Federal Reserve that says we're not done hiking. We have more work to do. I think they're going to go ahead and hike at the May meeting as well and then take their pause. And I think you have recession coming later this year. So with that outlook, we say to our clients, okay, where do we want to invest? Where do we want to put money? We don't want to be uninvested. We don't want to take money out of the market. We want to be a little bit more defensive. So we look at areas like healthcare. And I know it's been overbought recently, but if we're looking 3 years out, we still think there's some positive names you can have there, especially in the HMO space. You look at some of the biotech names. If you want to have a little bit more cyclicality, we like credit cards. I think you have to have that balance coming. And I know tech, everyone has been piling into tech. It's overbought at this point. I think there are what our CIO, Bob Dahl, likes to call profitable tech, a little bit more defensive than the high flyers. You can go in there as well and look at some names like a Cisco or a Qualcomm. So there's areas to invest, but I think you do need to take a step back and be a little more defensive with the outlook that we have.
Data dependent. We've been talking about how that means something different to everybody in terms of which data points they look at. What data matters most to you?
So, Lisa, it's funny because I think any data point that you give me, I can probably make either a bull case or a bear case out of that data point, right? Whatever my bias is. When obviously CPI in 20 minutes or so is coming out, everyone has been looking at that services number, the core services, the super core, taking out the rent component, what the Fed's looking at. I actually think this month we need to be looking at the goods component. The goods is where we've had all this disinflationary pressure as of late. It's why we've seen these numbers come down, the headline numbers come down. But let's look over the last month. Apparel's gone up. Furniture's gone up. Used vehicles has gone up. I would be very concerned if all of a sudden we're seeing goods numbers, goods inflation move higher when that's been the catalyst for disinflation over time. So I think look at some of those underlying numbers, continue to watch the labor market, not necessarily the headline number. In my opinion, it's the JOLTS number you want to watch. We can make a labor market that, starts to have a few cracks in there by taking some jobs off the table, by having the participation rate move higher without necessarily having layoffs. So watch the JOLTS number, watch the goods component of CPI. I think those are going to be your drivers as of late.
That's a soft landing hope, that's for sure. Victoria Fernandez across Mark Global Investments. Lisa, not so long ago, it was job openings. That was a target, an objective. We wanted that to come lower. We didn't want unemployment to shift higher. We kind of got that last week.
We did.
Didn't we?
We got exactly that, and that should have been really positive, and people shrugged it off, and it was a non-event after it happened. So at what point does data get dismissed if it just doesn't really change the narrative all that much? And I think that that's what we keep seeing. Is today going to be a snooze fest if it comes in bang in line with projections?
The market strategist from Texas dovetails with the economist from Toronto, David Rosenberg. And Rosenberg is heated that goods is being underweighted right now, and the goods inflation is massively disinflationary. And if you get to a true deflationary trend in goods, which is where we were pre-COVID, do we need to overweight this analysis of service sector inflation? I'm not sure at 8:30 we do that job.
It's always highly dependent on the seat that you're sat in. Now, if you are in the bond market, a market participant, I would take the words of Connor Sen of Bloomberg Opinion, who said in the last week, the economy is guilty until proven innocent. If you're a policymaker at the Federal Reserve, or for that matter, if you're Secretary Yellen, you believe the economy is innocent until proven guilty. And the accusation, of course, is recession. And that's the conversation we'll keep having. I think that's the disconnect as well between what the market is pricing and what the Fed's projecting. The Fed can't sit here and say recession foretold. I think people in the bond market are willing to do that. Some people are. And that's captured by pricing at the moment, with the 10-year at 3.44 and a 2-year just north of 4% after being north of 5%. Not so long ago. Equity futures positive a tenth of 1%, 18 minutes away from inflation data in America. And I've got one eye, a sighting of Mike McKee.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Belfast today, President Biden met with British Prime Minister Rishi Sunak. Before the meeting, the White House said it didn't anticipate the two would discuss British calls for a resumption of trade talks. Instead, they were expected to talk about peace and investment in Northern Ireland and efforts to support Ukraine. The Biden administration is proposing a tough crackdown on auto pollution. Tailpipe emissions limits will be so strict it will compel automakers to ensure 2 out of every 3 cars sold in 2032 are electric models. Still, there are questions whether car companies can fulfill the limits on carbon dioxide and smog-forming pollution. Donald Trump wants a 4-week delay in the start of a civil trial over his alleged rape of author Jean Carroll. Now, his lawyer says a cooling-off period is necessary following his indictment in the case of hush money payments. The trial in the Carroll case is due to start April 25th. And Elon Musk says that most of the advertisers who fled Twitter after he bought the company have returned. Musk spoke in a Twitter Spaces interview with the BBC that attracted more than 3 million listeners. He also defended firing thousands of workers, and Musk turned the tables on his interviewer, questioning the BBC over hate speech and COVID disinformation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think the last hike was also an error on the part of the Fed. And data dependency is fine as long as you're not dependent on the wrong data. But if you're looking in the rearview mirror, then you're going to be igniting boom and bust cycles. And I'm afraid we're moving into the bust part of the cycle.
This really has been a feature of the conversation this morning on Bloomberg Surveillance. That was Mike Dowda, the chief economist and market strategist at Roth MKM Partners. This line right here, it's fine to be data dependent as long as you're not dependent on the wrong data. And Lisa, that's the conversation we've had so far this morning.
And what do you know what the right data or the wrong data is? What's the forward-looking data? What's the backward-looking data? These are the bulls in the equity market saying, if you look at the strength in the economy, you're not seeing the recession, so stop it already. And in the bond market, they're saying you're just not seeing it yet, but it's going to come.
Inflation, 13 minutes away. The bond market being proactive about all of this, discounting this idea that things are going to be, All right, okay, fantastic.
I relate to the bond market.
I'm sure you do. Equities right now, going into the CPI report, look like this. Equity futures positive by not even 0.1%. Yields a little bit higher through this morning. The 10-year, Tom, 3.44, higher there by about a basis point. The 2-year up by a couple of basis points to 4.05%.
The 10-year there, I'll look at the 2-year here in about 12 minutes. Right now, before we get to Michael McKee, Gregory Valliere joins us, Chief U.S. Policy Strategist at AGF. Greg, it's been a very cold spring on the East Coast. The Washington weather has been lovely. It makes us look forward to summer. Let's go to the debt ceiling, the issue no one's talking about. What is the path of the debt ceiling debate from this beautiful April morning out into July and, dare I say, to the fall?
Well, good morning, Tom. To my shock, nobody's talked very much about it. We have to have our taxes in by next Tuesday, I think. So the tax receipts will make a big difference in terms of the timing. When do we hit the wall? Probably late June. It might go into July. We have to remember they're gone for the whole month of August. Kevin McCarthy has wound up in a feud with many of his Republican colleagues, and they don't have a deal yet.
Maya McGinnis, expert on fiscal entitlements, suggests there's trouble out there X number of years. Within the debt ceiling debate, is this a Congress, is this a Washington that can do a redux of Simpson Bowles? Are we going to have analysis this year about the entitlement crisis that could be out there 7, 8, 10 years?
No, that would take too much political courage, so I don't see that. They won't deal with Social Security and Medicare until the crisis is absolutely imminent, and we're not there yet. Very briefly, two big fights here. One is to maybe reduce some spending, put a cap on some spending. The other fight is the debt ceiling and a possible default. On this latter fight, there's no agreement among McCarthy's troops. Many of them would not vote for a debt ceiling increase under any circumstances.
There's a lot of nuance here, and there's a lot of detail, and neither of which plays well in stump speeches and in commercials. What does speak well is when people blast the Fed, and we have seen that consistently through election cycle after election cycle, and now we're seeing it from Ron DeSantis, who may be running. We're not sure. He's on a book tour currently. I'm curious what you make of that, if that basically increases the politicization of a Federal Reserve amid a CPI report that we're about to get and a real deep angst about how to deal with that inflation.
Well, that's a really good point. And all of a sudden, DeSantis is down in one poll I saw this morning by 33 points. Trump is ahead by 33. So DeSantis needs to shake things up. So he's going to go after the Fed. I don't think that's going to really succeed for him. And I would say this about the Fed. If there's a wild card at the next Fed meeting, it's commercial real estate. It's the concern, I think, within the Fed that defaults are going to become a bigger and bigger story. That may tilt the scales to just one more move, and they may then say, we're done because of commercial real estate.
How do they justify that, though, Greg, if their mandate is full employment and reducing or getting some sort of price stability? How do they justify that they're going to pause raising rates in the face of a hot inflation read that we're expecting to get just shortly here by saying commercial real estate looks problematic?
Well, it's hard to justify, and they still have egg on their faces in San Francisco and with the Silicon Valley Bank. But I think that the fear of contagion stemming from the commercial real estate drop. I mean, you walk around Washington, D.C., guys, there's no one in the streets. There's no one in the offices. So I think that the Fed has to acknowledge that if they stay really tight, you're going to get contagion.
I've always found like that about Washington. Do you ever see people in the streets here in D.C.? Isn't that always the way in D.C.? Whenever I'm here.
I was sitting in a car yesterday, and we didn't bring the Bentley down, but I was in a car, and the bottom line is the traffic's 1/3 what I've seen before.
I never see anyone in this city.
It depends where you go. There are actual neighborhoods, and then there are like the office building, canyons that were, All
right. Greg, thank you. Greg Valliere of AGF Investments there. Inflation data about 8 minutes away, so Mike McKee's gone on tour. He's come down in Washington with us this time to break the inflation news. Morning, Mike.
Good morning. You break it, we fix it, yeah.
We're looking for something sticky, something hot in 8 minutes?
That's a good question, and there are a lot of people who think we will see some stickiness to it. We expect that gasoline prices went up, and that'll push up headline numbers. Used cars have been in an unusual situation, and at the wholesale level, they've gone up. It hasn't fed through yet, but at some point, we're going to see housing start to drop because rents have dropped. So nobody's quite sure what we're going to get here. The feeling is we get a slight drop in headline overall, and we get a basically unchanged core.
What's food doing?
Food has been, at this point, rising at a fairly steady pace, about 0.4% per month.
What are berries doing?
Tom.
On radio, it is Keene knows this. Washington has the best food.
They have berries.
John, they have fresh berries. They have protein.
John is moving here.
Seriously.
Fresh fruits and vegetables were up 0.2%.
Oh, you've actually got the numbers.
Yeah. I've got that right in front of me.
Well, can I ask a question? We were talking about before while Tom enjoys his berries on air. I'm curious about this disinflation that we saw in goods and now a reinflation of that disinflationary force. You talked about used cars. Used cars prices increased in the month of March, according to the latest Manheim indexes. We've also heard that furniture prices are increasing, et cetera, et cetera. How problematic is that with the sort of rolling recessions now rolling the other way?
Well, it could be a problem if that all holds. Now, we've gotten some data from both Barclays and Bank of America on their credit card spends in the recent month, and both have reported goods spending down significantly. So that'll take some price pressure off. It's the services that the Fed is still looking at. And, of course, today we'll have our fancy graph of the J. Powell indicator, core services ex housing.
Are you seeing a little bit of division on the FOMC? Just starting to emerge, just a few voices looking for patience here.
Well, I think that a lot of people have been looking for patience, but no, they all say we'll go one more and then we'll look around. There are some who've said, well, we'll go one more and then we'll see if we need to go more. But remember the dot plot. The median dot was at 5.1%, but there were 7 above that, including 1 at almost 6%. So it's not like this is anything new. They're going to be data dependent.
Are we just finding out who those dots might be?
Yeah.
Who those people are?
Essentially, that's what's happening.
Do you know who the dots are?
No. I mean, some people will tell you, and some people won't. I mean, we have a pretty good idea.
I'm laughing.
Jim Bullard's at the top.
I'm just imagining, who are the dots? Who are the men behind the dots?
Don't get me going.
A Bloomberg Surveillance special.
How different is Goolsbee from Charles Evans? Austin Goolsbee, Chicago versus the previous Carnegie Mellon Charles Evans.
Well, they're both very talented and experienced economists, so that stays the same. Goolsbee seems to be a little bit more dovish at the moment. Charlie Evans moved around with where he thought the data was. Sometimes he was hawkish, sometimes he was more dovish. The question now is, what does Goolsbee do when situations change? If we get to 5.1%, if the economy starts to slow down, and if we see any need for the Fed to start cutting rates, then how quickly does he jump on board? But again, we're all talking about 25 basis point moves in very small increments, so hawk and dumb is kind of a...
Yeah, gone are the days of 50 and 75 and talking up the potential for 6. That was only a month ago.
I know.
It's changed so quickly. Inflation data about 5 minutes away. Mike McKee's going to break that down with us in just a moment. CPI just around the corner. Jay Bryson of Wells Fargo is going to join us to break this one down. Going into it, equity futures just about positive. Yields a little bit higher. The inflation report in the United States of America, seconds away, 20 seconds away to be precise. Going into it, equity futures look like this on the S&P 500. Just about positive by 1/10%. A little lift after closing unchanged in yesterday's session. The Nasdaq a bit softer over the last 24 hours. Going into this report, we're up by a basis point on a 10-year, 343.40 on a 10-year right now. The inflation data in America just dropping. Mike McKee has more. Hey, Mike.
Well, it looks like we're starting off on a reasonably good note, or at least one that parallels what economists were anticipating. The headline CPI comes in up just 1/10. That's down from 0.4, and also lower than the 0.2 that was anticipated. Puts the year-over-year number at 5%, down from 6%. So a significant drop in headline CPI. The core comes in at 0.4 increase, which is what was anticipated. That's down from 0.5, and we're seeing a core rate on a year-over-year basis at 5.6%. That's up from 5.5% in February. So basically what we're seeing here is what economists anticipated, and whether it's going to give you any kind of significant indication about where we're going is kind of up in the air. You can make anything out of this that you want, because the headline number probably influenced by energy. I'm just looking now, energy down 3.5%. Gasoline prices down 4.6%. Now, we've known they've gone up since then. And here's an interesting one. Natural gas prices, and I guess this is not a surprise given that winter is essentially over. Natural gas prices down 7.1%, the utility natural gas that you would pay. Food prices flat. Tom had asked before the break, what's food doing? And it had been going up consistently, but not now. It has fallen back some. And rents, they have not made progress, it looks like. Shelter costs up 0.6. That's down a little bit from the 0.8 the months before. And rent of primary residence and OER up 0.5%. So we're still seeing the housing impact on the overall numbers, John.
So we've talked about the inflation report relative to what economists expected. I think the market telling you what the market was looking for going into this one. Look at this move in the bond market. Yields lower by 9 basis points on a 2-year, taking back some of that post-payrolls pop at the front end of the curve. We're back to about 390 on a 2-year. On a 10-year, yields down by 5 basis points. Just sub 340 on a 10-year yield in America. Off the back of that, some enthusiasm in the equity markets, equity futures, a bit of a pop here by 0.75% on the S&P 500 after being virtually unchanged going into the print. In line for core inflation, down from the month before. Headline inflation, a whole lot softer than the previous month, and a little bit of a downside surprise relative to expectations. So equities higher off the back of this, Tom, by 0.75% on the S&P, and a rally in the bond market. The initial knee-jerk reaction to this one, yields lower.
I'm going to pick, there's 8 ways to go here, John. I'm going to pick the equity market here. Dow futures above 34,000. John, can you imagine if we get to Standard & Poor's future level of 4,200? We're not quite there. That's what everybody's following. But at some point, given this economic data, you're going to get a stock market cover of the shorts, the gloom, the caution that's out there. Where is that throw in the towel mood, given this kind of economic data? It's out there somewhere. I don't know.
I'll paraphrase Michael Harner of Bank of America, who said recently that we're too optimistic about rate cuts and not pessimistic enough about the reasons for those rate cuts. And I think that's a really, really important call. Tom, there's a difference between getting that disinflation the Fed is looking for without significant economic pain. There is a worry that the banking developments of the last month will lead to significant economic pain, and I don't think we've cleared that hurdle just yet.
This is precisely the point where, and Darda mentioned this, Michael Darda mentioned this yesterday, do you get a disinflation with okay GDP, or does GDP really come in? And that's the raging debate given disinflation.
If you're on the FOMC after this one, Lisa, and you looked at this print and you were already sitting there pleading for patience, did you get a little bit more information, some data on your side that would take away some of that urgency to do more?
No, I didn't. And that's what I find surprising. And I'm looking at this market and not understanding what they're looking at. And I want Michael McKee to weigh in on this. Did you see any progress whatsoever other than the fact that you basically had transitory types of food and energy prices make a move in the positive direction?
It's the core that went down. The food and energy prices went down significantly, especially natural gas. Gasoline prices were surprisingly down as much as they are, because we all know they've gone back up in recent weeks. Used cars and trucks down 11.2%. So whatever is happening between the wholesale numbers and the retail numbers, we are not seeing any kind of action. New cars, however, were up 6.1%. There's still a shortage there, which some say the automakers are encouraging because it keeps the prices higher.
So John just asked me, if I were on the FOMC and I got this data, would I feel comforted? If I otherwise was moved toward this sort of pause or more cautious approach, would this give me some sense of confidence in that approach? Do you think that it would?
I think it would reinforce the idea that you're on the right track, and that what you need to do is leave rates high enough so that the cumulated effect of all your rate increases starts to have a greater impact. But what they're really going to want to see, and they won't have by May, is evidence of what's happening in the housing market. We've been anticipating, but because of the lags in rents falling and getting into CPI, most economists have said we won't see it until like the May numbers, which we'll get in June. At that point, we might see a big drop, and that's another reason why the Fed may want to, express caution coming out of the next meeting. I'm not sure they'll say we're done, but they will dial back the idea that a rate increase is automatic at the next meeting.
Quite a move in the equity market. A pop on the S&P 500 of almost 1 full percentage point. Yields lower now at the front end by 14 basis points. I think we often stress in the minutes after any big data point, payrolls or CPI, sometimes these moves don't stick, but this is quite a significant move at the front end. We're down about 14, back into the 380s on a 2-year. The 380s is where we were trading Friday morning, Tom, going into the payrolls print. So we've taken back some of that post-payrolls prop. I don't think this changes the consensus view at the moment. Consensus seems to be the Fed goes again on May 3rd. But certainly, if you were of the opinion that the Fed should be more patient, maybe that provides you with some more evidence to be so.
I don't have the technicals in front of me, but, John, I agree the 380 level is critical for, and I'm talking in a broad sense of 10 ticks, and the 2-year yield to see a 379. We're not there yet. That would be a big deal. To parse this, as Michael McKee dives into the data, is Jay Bryson, chief economist at Wells Fargo. Dr. Bryson, thank you so much for joining today. One set of data does not make a trend. If we put together 3 months like this, what does it signal to Jerome Powell?
Well, so, I mean, if you look at the last 3 months, right, that core rate was up 0.4%. And so if you look at the last 3 months, you're still running at an annualized rate of close to 5%. There. Now, the good news is that the rent component, or the owner's equivalent rent component, is starting to come in. And so that should continue to put some downward pressure on inflation as we go forward. But we're still a long way from 2% at this point. And so, if you're Jerome Powell, you look at this and you say, I think Mike just said it, we're on the right track, but I don't think this makes the case for a pause in May. This and what we saw earlier in terms of the jobs report, I still think, knowing what I know right now, that they go 25 in May.
A lot of people agree with you, and yet they seem to be increasingly pricing out the potential for further rate hikes and possibly a great rate cutting cycle to start in the second half of this year. Jay, what would we have to see on Friday to discount the strength, the underlying strength and core that we see in this report, albeit perhaps not more than expected?
So when you say Friday, Lisa, are you talking about the retail sales numbers we're going to get out on Friday?
J.P. Morgan's earnings. J.P. Morgan earnings, bank earnings, and how much that lending stress.
Yeah, so, right, if we're starting to see signs, and, in the upcoming bank earnings, there's a lot of stress out there in the financial system, with banks in terms of their earnings, in terms of the credit standards, tightening, things of that nature, that potentially could start to swing things in the direction of a pause in May. I mean, we'll see. What they say, what the banks say in the coming weeks here. But, I think at this point, that would be the thing that would, for me, would say, okay, maybe they actually go and pause, is what sort of stress we're seeing in the banking system.
Jay, there seems to be a complacency in markets about the fact that the Fed will be able to get inflation under control, that the rates will go back down to 3 or perhaps even 2% in the next couple of years. And I'm talking about 10-year yields. Are you less confident about that based on the increasing pressure for them to pause or just take a step back as they wait to understand what the dynamic is?
So in terms of the longer end of the curve, Lisa, I could see that going back to 3%. I mean, I just think that given the structural challenges in the U.S. economy today in terms of its long-run growth potential, for me, a long-run 3% 10-year yield makes perfect sense. I guess where I have a little bit more question is in terms of the 2-year yield. I don't agree with the view that the Fed's going to be cutting rates by the end of the year. I mean, potentially, right? If we're in a recession at the end of the year, I could definitely see that. But if we have, a soft landing in the economy, I could see the inflation rate here getting stuck at 3 to 3.5%. What does the Fed do at that point? Does it throw in the towel? And does it say, okay, we can live with 3 and 3.5%? Or do they really mean it? We need to get back down to 2%. And if they need to get back down to 2%, then you're not going to see, I think, rate cuts at the end of this year. I think you're going to see rates remain at a minimum elevated at that point. And so I have a little bit of a disagreement where the 2-year is right now.
Hey, Jay, you're not the only one. Jay Bryson of Wells Fargo, thank you, sir, on the latest inflation data in America, which spurs a big move at the front end of the yield curve. Yields lower by 11 basis points now. You can round it down to 12 if you wish. About 3.90 on a 2-year at the moment. Equity markets with a real lift, still positive by 0.8%. The latest data, 0.1% month over month on headline inflation. We were looking in our survey for a median estimate of 0.2%, so that's a little bit lower than expected and much, much lower than the previous month-over-month move. If you look at core, strip out food and energy, that comes in at 0.4, in line with expectations, and a very, very slight improvement on the previous month-over-month read of 0.5%. Seemingly, Tom, the takeaway from this one, this breathes a little bit more life into going again in May. Right. It doesn't provide more reason to do much beyond that. And I think that's the story that you see emerging at the front end of the curve.
Quickly here, the McKee cam shows a McKee that really needs to weigh in here. What do you got?
Well, I've got everybody's favorite number, the J. Powell index, which is core services X housing. And it's a major improvement from 0.43 increase in February to 0.29. So we're down quite a bit there. That's the headline. And the BLS does say in their release that it was housing and rents that really pushed up the CPI, offsetting the energy price drop because housing is such a big component in the CPI.
Equity markets picking up at 0.8% on the S&P 500. In the next hour on Bloomberg TV, Priya Misra of TD Securities, Colin Martin of Charles Schwab, David Kelly of JP Morgan. All of that coming up in the 9 o'clock hour on Bloomberg TV.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. China indicated it will maintain pressure on Taiwan following its large-scale military drills. The maneuvers began after Taiwan's President Tsai Ing-wen met last week with U.S. House Speaker Kevin McCarthy in California. A Chinese spokesman said, quote, "We will not leave any room for any form of Taiwan separatist activities." Ron DeSantis travels to Ohio and New Hampshire later this week after stumbles left him further behind Donald Trump in the race for the Republican presidential nomination. The Florida governor is expected to formally enter the race after the state legislature wraps up in May. In the Real Clear Politics average of polls, DeSantis trails the former president by 26 points. Emerson Electric has agreed to buy National Instruments in an all-cash deal valued at $8.2 billion. The price represents a 49% premium to National Instruments' closing price on January 12th. That was a day before the maker of measurement systems announced a strategic review. Mortgage rates in the U.S. have dropped for the 5th straight week to their lowest level in 2 months. According to the Mortgage Bankers Association, the contract rate for a 30-year fixed loan falls 10 basis points to 6.3%. Meanwhile, the group's index of mortgage applications rose 7.8%. And American Airlines says that first quarter profit will likely fall short of Wall Street's estimates. Persistently higher costs are countering some gains from travel demand. Meanwhile, there have been signs that consumers are opting for lower fares, and there's been a recent slowing in bookings. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I was at the front line of the 2008 financial crisis. Every time we thought in 2008, okay, we've done enough, it's over. Things flared back up again and they got worse. And so I'm not ready to declare all clear, but there are hopeful signs that these risks are now better understood and calm is being restored.
As we heard from Goolsbee of Chicago yesterday, Kashkari of Minneapolis there, Neil Kashkari, the Fed president for that important Fed, best in the nation on child care economics. They own the high ground on this coming out of the pandemic. What are we going to do about infant care in this nation Right now, in a moment, we're going to get to Jeff Rosenberg, but we've got to mop up here the bond market dynamic, and Lisa Abramowicz does that better than anyone. Lisa, I'm looking at the 2-year. What do you look at?
Well, I'm looking right now at Fed funds expectations and basically slightly coming off some of the number of people who are expecting the Fed to raise rates at their May 3rd meeting, but still very much solidly priced in. It's the rate cuts after that that get my attention. Now pricing in about 100 basis points again of rate cuts by January. Was this report enough to justify some sort of sense that, yes, inflation is coming down, and that, yes, it's going to come down enough to necessitate rate cuts?
Some of the themes here in Washington. We welcome you on radio and television, the meetings of the IMF and World Bank, but far more now, inflation analysis and markets really moving on this. Maybe not like 10 minutes ago, but certainly a lift to equities with lower yields. To synthesize, Jeffrey Rosenberg joins, portfolio manager of Systematic Multi-Strategy Fund at BlackRock. He's been medicated over the last 4 months, the beginning of 2023. It's been chaos. I'm fascinated, Jeff Rosenberg, with your wide mandate at BlackRock, how you've survived 2023. What have you done to your given the cacophony handed to you?
Well, it's a good framing for the question in front of today's data, Tom, because it is particularly a period of heightened uncertainty around the outlook. We talked about it in the earlier segments in terms of the uncertainty around inflation. You know, we're moving through this period into a new period of, you know, I think a pause and a reflection from the Fed, you know, whether they hike in May or not. For our portfolios, you know, that's made directional exposures, whether markets are going up or markets are going down, you know, pretty challenging environment to try to pick that direction. We have the benefit of being able to do a lot more flexible things around our portfolio to take away the direction and really look underneath the hood and play the dispersion that we see in markets. And particularly, you know, one of the big stories is, you know, exceptionally high, historically high interest rate volatility relative to low equity volatility. But that low equity volatility is really a story of the surface. Underneath the surface, there's tremendous amounts of dispersion, and we're trying to take more advantage of that and lean our portfolio more into dispersion than in direction.
As you avoid trying to take a call on necessarily what's going to happen at a time where that seems to be pretty much impossible, Jeff, I'd love your read on what we just experienced, which is an almost in-line inflation report for CPI, the core CPI coming in line with expectations, and this market cheering and actually now expecting even greater rate cuts in the next 12 months. Does that make sense to you?
Well, I think Jonathan Ferro has said this in a couple of contexts, maybe more around payroll. Be careful about, you know, the initial market reaction as to whether or not that's the longer run message. But the initial market reaction is really talking about, you know, the beat on headline and the impact on food and energy prices. You know, it helps, and it helps a lot in terms of the optics around inflation going down. I think that's the near-term market reaction. The stuff I'm focused on and we're focused on is really about the labor markets. It's about wage inflation. It's really about what we see in this report in terms of core services ex shelter. I think Mike mentioned that in the earlier segment. You know, there's a little bit of a trend coming down there. I wouldn't read a huge amount into this report in terms of giving the all clear for that much more important and durable services inflation. I think it's a positive. It's in the sense that it wasn't a big negative surprise upward, and I think the market is trading a little bit off of that, but mostly off of the headline here this morning.
As we careen toward that May 3rd meeting of the Federal Reserve, what are you watching to get a sense of what is going on in real time beneath the hood with credit lending, with the expansion or contraction therein?
Yeah, I mean, obviously the big uncertainty, and Powell characterized it very well, in that the direction of the banking crisis in March is to contribute towards tighter financial conditions, to contribute to the transmission of tighter monetary policy. The direction is clear, the magnitude is not. And so everyone's focused on the weekly H8 report and what's going on with bank lending. The issue, though, is that bank lending and bank lending expected standards tightening had been in place well before the banking crisis. So the issue isn't whether or not banks are tightening credit. The issue is how much did the banking crisis in March accelerate those trends. That is very hard to measure. It certainly has accelerated something we can measure, and that is deposits moving out of banks and into money market funds, waking up to it's no longer zero interest rates, and that's perhaps accelerated the funding costs of banks. But whether or not that transmits, whether that's a bank margin issue or whether it's a real economy issue, remains to be seen.
Jeff Rosenberg, in the equity space, we can talk about bull market, bear market. We can talk about movements up, ratios and such. In the bond market, we do less. Are we in the beginning of a bond bull market, which is generally price up and yield down? And if I use the 10-year as a proxy for that, do you frame out a surprisingly lower 10-year yield out 1 year or 2 years?
I think the jury is out on that kind of 1 year, 2 year framing of the question, Tom. Clearly, what's been happening over the last couple of weeks, really since and kicked off by the banking crisis. Remember, pre-banking crisis, we were debating, a 50 basis point hike and whether the Fed needed to do more. We kind of forgot all about that. Because it's really much more a pivot towards, did this banking crisis accelerate tightening? I think the jury is out, but clearly the momentum in the bond market is towards more of a focus on recession risk. And as Lisa was talking about, the pricing in of, a very rapid turn towards Fed cuts. We think that's probably overstated, but that's where the market's at right now.
Well, I want to be junior portfolio manager today. If people are saying long duration does better, big tech and equities does better, is this the time for Jeff Rosenberg to do a Jeff Vinnick, George Vanderheiden redux from 30 years ago? And do you need to go out and buy a 20-year zero coupon bond to play a long duration play over a year or 2 years or 3 years?
The long duration call is really about recession versus inflation. And right now, as you can see after today's report, it appears that inflation fears are waning, and that's going to give some more credence towards the notion that duration can once again play the diversifier in a recession environment. You want to be, out as far in duration as you can stomach. We're a little bit more cautious on that view, however, Tom. And again, it was to my comments that, today the market is kind of playing off the headline. It's the services piece and the inflation from the wage picture and these still very tight labor markets. I think we still need to see that loosen up before you can say it's all clear and we're back to duration is unequivocally a clear hedge to a recession risk. It certainly is if you get the recession, but it becomes much more vulnerable if inflation is more sticky than we're currently anticipating, than markets are currently
Jeff Rosenberg. Well, Jeff, thank you so much. Jeff Rosenberg, always with BlackRock. Lisa, I think this is just absolutely critical. And the way I would look at this is the visible, tangible bets on a short stock market that's out there. Nobody loves equities right now, which tells me nobody loves long-term duration fixed income as well.
I don't know how we can really understand what people love or don't love because they're buying protection against a downturn. They're renting the protection. They're not necessarily selling. And you're seeing that with respect to big tech, for example, where people have really bought quite a bit in the past couple of months. In terms of the bond market, I don't know how much signal, I don't know how much noise. The bond market's gotten noisier and noisier. That MOVE index with volatility surged to the highest levels in more than a decade just a couple of weeks ago. And you're just feeling that churn in trading positions.
The din in Washington is going to get noisier as well. In earnest, the meetings of the IMF and the World Bank, many narratives, including the fragmentation between America and China. Stay with us through this Washington day. This is Bloomberg Surveillance.